Good day, ladies and gentlemen. My name's Ryan, and together with Aaron, we are the RA 2-in-1 podcast, a really adult show. Welcome back. So it's been a while, Aaron. How are you?
Not too bad. You guys have to excuse me a little bit today because my vocal cords are injured.
Oh man, that sounds rough. Hope everything's okay with you.
Yeah, I'm okay. Just that you guys have to excuse my voice today, but we should be able to record lah. Should be no issue. Just that my voice might not be in its best condition.
Absolutely no worries, Aaron. So why don't we go and dive right into the topic of today, and that is diversification. So it's probably one of the first few things that you've ever learned when you first started investing. Don't put your eggs into one basket, right? That's what the saying goes. Well, is that actually true? Is that the case? Should you actually diversify across 500 different companies through an index fund? Or should you actually focus down, narrow into a couple single assets to help you gain that optimal performance that everybody dreams of? So nowadays, a lot of people actually prefer to use more passive methods to actually invest in money. And some of them actually engage in financial services, or rather, a majority of the people out there actually do engage in financial services to help them invest in money passively. So this includes using methods or companies like banks with the unit trust and mutual funds, as well as more recently robo advisors. So is that actually a good thing? Because these funds are actually pretty diversified in my opinion. So, well, would you like to speak a little bit about that?
Yeah, sure. I think one of the main vehicles that most people use when they start out investing, right, is usually they speak to their financial advisor lah. I think that's like the main key that how most people start, right? But of course, today's most people have their so-called robo advisors to help them. So I won't name the robo advisor, right? But essentially, I think during the whole COVID shutdown, right, there was a robo advisor which basically like marketed very heavily, right? Then they attracted a lot of attention. So the first year, I think when they marketed, it was pretty good. But I think the second year, that's when they started to change their portfolio a little bit too actively. Then that's when it started to go quite badly for them, lah, right? I think when you diversify using mutual funds, right, one of the main issues that I think mutual funds have versus, let's say, an index fund, right, is that the cost to run that fund is actually pretty high. Usually, they'll charge you between 1 to 1.5% to hold shares like Microsoft, hold shares like Amazon, hold shares like the FANG stocks are. If you actually go and open up the mutual fund fact sheet, right, you realize that a lot of these top 10 holdings, right, are names that actually, right, if you go to the S&P 500, they already hold. So when they take when they take 1% of the fees, right, it might not seem a lot right now, right? But if you actually like compound it at over many years, right? A very good illustration to show this, right, is that the long run, let's say 25, 50 year, 50-year time frame of S&P 500 return, right, is about 6 to 7%. So if you take away about 1%, right, that can be up to like 15 to 20% of your end return. Because you just take 1 divide by 7, right, then that's pretty much you get more than 10% of your performance is gone just due to the fees alone, right? And some mutual funds, if you go to those very far outskirts, right? Maybe you go to places like ASEAN, maybe you go to places like India, where the frictional cost is very high. And sometimes you buy real estate, the mutual fund cost can be as high as 2%, right? So if you take 2%, right, it's close to like a whopping 20% of your performance. So the reason, right, why mutual funds, a lot of them cannot outperform the S&P is very simple because they are a subset of the S&P. Because if you look at the fund fact sheet, right, a lot of them are basically just subsets of the S&P 500. So on top of that, right, when you pay this particular percentage, right, a lot of these mutual funds don't actually guarantee your returns. That is a fact. There is no guaranteed amount. So basically, you're taking equity risk, but then there's no return, but you're paying 2%, 1 to 2% of the fees. So that is mainly why it never outperforms lah. Right. In fact, the results are so bad, right, that if you actually like go very long, right, like you're talking about periods, time frames of about 10 years, just 10 years itself, more than 90% of mutual funds will never outperform the S&P 500, right? So, right. And then one of the main reason is also because you just take a look at Cathy Wood, right? Her ARK funds, right, cannot outperform, right? Largely because her best idea, which is Tesla, she cannot put more than 10% of her funds inside, right? Because of regulations.
Yeah, I believe the maximum that she can actually put is 10%.
Yeah, they only can put up to 10%. And that is pretty much the limitation that mutual funds have, because the main priority for a mutual fund is to make sure that everything runs as smooth as possible, and they don't really, I mean, their main priority is not to get a lot of return for the shareholders or the mutual fund holders. Their main priority is to make sure that, money is inside and then they don't lose too much. So they really try to avoid losing as much downturns as possible. But the problem is, right, if you actually go and take a look at the mutual fund performance, a lot of them actually track the S&P 500 even worse. Yeah, so in a way, it's like a very inefficient index fund, because the liquidity is only dependent on the market, which is the mutual fund holder. So you're like trading in a small town, when you can just buy the S&P 500. So that's one of the main reasons. So this is also the reason, right? This regulated 10% max is also the main reason, right? Why people like Warren Buffett, they never start mutual funds, right? He actually used the vehicle, a business vehicle of Berkshire Hathaway, right, to actually invest money, because, so that he will not be limited to this 10% allocation. And it is not uncommon, right, which we'll talk about later, for you to see people who outperform, right, like Warren Buffett, where he actually had about 30% of his the portfolio invested in one idea. It is not uncommon. So cost is number one. Number two is that they cannot concentrate. And the last one, right, which is very detrimental, is that a lot of these mutual funds or hedge funds, right, they are actually assessed every quarter. All right. And because they are assessed every quarter, they are very pressured, right, to provide short-term performance. Okay. And that is not correlated to actual business practice. Because it's very rare, right, for you to actually see businesses move so fast within 3 months, especially big businesses. Anytime your business revenue is about anywhere between 1 to 2 billion, right, for you to see super fast growth, right, in like every quarter, it's not very common, right? And even if it's common, all right, you also cannot put concentrated positions. So you see the little dilemma that all these like mutual fund managers have. They have a lot of like handcuff issues. They cannot run like business people, and their main objective is to basically ensure that you don't lose too much money. So over in the long run, right, it's like you're trying to run a marathon, right, versus a business person, right, with ankle weights. Very difficult to win. Yeah.
I mean, to begin with, for me personally, if they keep changing their portfolio every quarter, right, or like they make changes on a quarterly basis, that's like the opposite definition of passive investing. The moment you make like more trades than usual, right, you will incur all the so-called the trading charges, and then if you do trading across different markets, then you will incur not just the trading charges but also the forex charges and everything. So they package it nicely. They call it management fees. And for a passive investor, long term speaking, it's more likely than not you will experience a loss versus a gain compared to just hodling.
Yeah, and not only that, also in practice, it just doesn't really make sense for them to outperform numerically, right? The number of people who actually does outperform is really like I can count with like my two hands. Like it's really very little, right? Peter Lynch is one of them. Ray Dalio is also one of them. And then Ray Dalio, his outperformance is about, I think, 2%, if I'm not wrong, compared to his benchmark. So even by metrics of outperformance, right, you really rarely very see if the time frame is long enough, right, that actually all these fund managers outperform over a prolonged period. Even Warren Buffett and Berkshire Hathaway, right, they have not been outperforming over the last 5 to 10 years because they have really reached a size, right, where it is very difficult for them to outperform, right, because of their scale, right. So I think today is also a little bit insight about Berkshire Hathaway, because they are the best performing so-called portfolio manager, right? But also, I think there's a lot of misconception, right? When you see a lot of this like advertisements on YouTube or whatever, like stupid social media like advertisement is, right? Where they like to quote people on Intelligent Investor, like they like to quote Warren Buffett and Charlie Munger, right? But a lot of the times, the problem that they quote, right, is that they are very misinformed in a way that how these two people actually like get the alpha in terms of getting the outperformance. And the fact of the matter is, right, they are actually not just investors, and they are actually business operators, right? They actually didn't really run a portfolio management per se. They actually ran a business, and they actually used the vehicle Berkshire Hathaway, and before that it was the Buffett Partnership Limited in the 1960s. So when they started this so-called business, right, it gave them huge flexibility without the portfolio management regulations, right? They can put up to 25% of their funds in a single bet. And in doing that, right, when they put 25% into a single company, it also gives them the ability, right, to actually have board of director positions in the company, right, to influence management and the cash utilization of the companies that they invested in. So, for example, if they go into a company, right, the example is Seas Candy. When they first bought the company, right, because the person wanted to sell, when they actually bought the Seas company, right, the meeting that they had with the manager who was supposed to run the place, right, the Warren and Charlie himself in the meeting, they told the manager, the most important thing that I want you to do is that when I buy your company, I want you to be in charge because I don't want to run the business. That's the first thing. The second thing is that I want you to negotiate a deal with the founders of this company so that nepotism doesn't exist in the business. I want to buy out the entire family so the family will have no say over the direction of the business. And that's what he actually very effectively did, right? With almost every single business that he buy. He didn't want nepotism and he wanted to make sure that the business he buy comes with management, right? So if you actually really go and read all his so-called business negotiation, right, you actually realize that he's a very efficient allocator of capital because when he buy a business, not only he makes sure that the business can run without him, but the last thing that he did very well is that for every single business that he buys, right, the money that the business generates, he basically becomes the owner and told the operator, right, to hand him the cash so they can invest in another business, right? And this is something, right, which so many portfolio mutual fund managers and so many so-called investment gurus are never talk about. And you know why they can't talk about it? Because all of them are literally think, right, that the only thing that these two people do is basically just buy stocks and wait without doing any active work.
Yeah, I actually feel that that couldn't be further from the truth. The main differences I actually observe from between the fund managers and investing gurus versus Warren Buffett and Charlie Munger, right, is that these managers and also the investing gurus, they diversify for the sake of diversification, if that makes sense. But in contrast, Warren Buffett and Charlie Munger, they diversify when they can actually identify growth industries, if that makes sense.
Yes, precisely. Precisely. You got it.
What they actually do is actually when they buy into a company, they get a seat on the board of directors, and then they actually control the company, and then they 10x the company.
Yes.
And then after they do that, the stock goes 10x. So either they continue holding and take dividends or they exit.
Yes, precisely. And the best way to illustrate this process is like, you guys like to watch this show, the Fixer Upper type of Property Brothers. Property Brothers, they like to buy undervalued real estate deals, right? Then they go in, they fix up the real estate, then they flip the property, right? So basically, Warren Buffett and Charlie Munger also do that. Because for those of these gurus who anyhow use their names, right, they also fail to neglect that the reason why these two people can buy undervalued businesses, right? It's because a lot of the business they buy, the business also comes with a lot of issues. And one major issue that American corporations have is legal issues, right? And why can they buy businesses with legal issues? Very simple. Because Charlie Munger is one of the top. He actually does have connections with one of the top legal firms in America. So he himself comes from a family of lawyers. So when they buy the business, right, Charlie Munger can precisely, right, know roughly how much is the legal exposure, how much is the cost to make sure that the settlement, whether or not is it high, whether or not is it low, and whether or not the legal settlement, right, is basically something which can be overcome. Right? A very good example is Washington Post. Right, that's one of the deals where I think they saw opportunity and they know that it was basically underpriced relative to the risk. So, I mean, this is the type of thing, right, where you realize if you really go down to the nitty-gritty, these are basically, right, moves, chess moves, right, from a business deals, right, that does not stem from portfolio management. Because portfolio management, right, what a portfolio manager does, right, is that he basically is just looking at, let's say you give him $100, his job, right, is to make sure he just put 5% here, 5% here, 5% here, 5% here, right? He doesn't go down, talk to the management, all right, and then basically give another business business blueprint, right, to do something that will 10x. He doesn't come in, right, and let's say he buy Microsoft, he doesn't come in, right, and then hey, talk to my kaki here, he got legal experience, maybe he can help you. None of this portfolio manager does that, so you cannot expect Warren Buffett and Charlie Munger results, because both of them did that, and that's why they have a lot of alpha. All right.
In fact, I feel for these fund managers, it's the other way around. So basically, they buy the stock, and then after they do that, they have to pull some publicity stunts like going up on CNBS or Bloomshade to actually promote their stock. But for Warren Buffett and Charlie Munger, it's a bit different. They buy into the company silent, they don't make noise, they grow the company. And by the time when they decide to exit, that's when the whole world will find out.
Yeah, and by the time they want to exit, which they ready to, most of them they never exit, right? They basically just buy and just make sure that there's cash flow, right? And I think that by itself, when we describe the process to you listeners, right, I hope that you guys understand, right, that this is one of the main reasons, right, whenever they say mutual funds can outperform, personally, after knowing what Warren and Charlie had to do to get that type of results and alpha, I can say with like close to 99.9999% certainty that mutual fund managers simply cannot outperform the S&P 500. This is pretty much like almost a guarantee, apart from death in Texas. All right. So the worst part, right, is that sometimes, right, when I hear that FAs, right, financial advisors who can proclaim, right, to outperform the index, right, through spectacular timing, to me, this is a super red flag and it's pure horseshit. Right, because to me that is a sales pitch. Because if you actually understand how, like, some of the greatest investors, right, they actually outperform the index, right. There's no way on earth you can really outperform, right, in terms of a diversified portfolio, okay, without doing active work. Okay, if you want to diversify and you still want to outperform, then you need to do active work. But if you don't want to do any active work, okay, the real way is that you cannot diversify. That's pretty much a fact. I mean, numerically, the best example I can give you is Cathie Wood. All right. She had to diversify, and because she had to diversify, she underperformed. She had to buy shit. All right. She had to buy shit. All right. Because if Cathie Wood, right, with all her knowledge, right, and she had the foresight to see what Tesla is going to be, and she basically had to go and buy a lot of shit, right? Because a lot of the businesses that she buy, right, basically they were overvalued shit. And she couldn't put 90% of her funds into Tesla, because if she did that, right, then everybody wouldn't buy her fund. Right. So sometimes when you understand this particular structure, right, you understand why mutual funds cannot outperform. So whoever is like trying to sell the idea that mutual funds can outperform, honestly, I've been in this investment world for long enough. I can tell you, investment mutual funds over 10 years, most of them, 99.99% of them will not outperform. The ones that can outperform, okay, the ones that can outperform, trust me, as retail investors, you will never have access to these funds.
Yeah, it's like the Renaissance Technology Fund, where there's like this very exclusive $1 billion club, and it's almost impossible for like retail investors to gain access to it.
Yeah.
And even when we are talking about like the Renaissance Technology, right, when their fund gets big enough, they will actually kick you out, because they need the small market cap, the total market cap, to actually sustain their strategy.
Yeah, precisely. So it's like chicken and egg thing, right? Because if on one hand, if you can outperform, over the long run you will underperform, right? Then if you underperform, then basically your promise is I can outperform. But if you never outperform, you just tell the investors, it's market volatility, it's not my fault. Everyone also don't outperform. So what's the solution? So this is why we did a podcast, because we want to talk about diversification, right? Because we just want to basically break the myth that diversification is for everyone. But I think that the right way to diversify, right, which is the next thing we're going to talk about, is not really to look at the way that you diversify through allocating capital. Right. The way that I look at diversification, right, which is the next topic on how to diversify the right way, is that instead of thinking of in terms of money, I would say that the best way to diversify is to think in a timeline. Okay. What do I mean by that? Very simple. Assuming that you are, let's say, average, 20, mid-20s, just out of university graduate, right? Assuming, let's say, you have money that you need, right, because you want to have a wedding, let's say at the age of 30, correct? Then after your wedding, let's say you plan far ahead, right? Maybe at age of 35, you know that you want to have your first child, right? Then you also want to buy a house. You have a wedding, you want to buy a house, maybe you want to buy a car, blah, 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 right? So the way that I diversify is very simple. Assuming, let's say I know there is a 90% certainty, right, in 5 years, right, that I need money, let's say for a house. All right. And then I calculate, right, I need, let's say, $150,000 in 5 years. All right. So when I diversify, right, I need to make sure that my fund that I allocate will have a 90% certainty, right, in 5 years, it will hit the amount. All right. So do I put some, if I know that there's a 90% chance I need this money in 5 years, right? Will I buy some, let's say I already have the money today, right? Let's say I already have $150,000 today. Then I know if in 5 years time I will need the money, right? Will I go and put into something very risky, like let's say Solana, 100% all in. Let's say Solana lah. Let's say Solana, $150,000 today. Then I collect in 5 years. I will not do that, right? Why? Because number one, the risk for this particular idea is very high. Correct. So I cannot diversify. Let's say 150K is all I need, it's all I have, right? And so how would I do it personally? Very simple. I'll take about 80%. I'll put it in the S&P 500. All right. Because I think personally, from my judgment, in 5 years' time, minimum I will break even. You know, the S&P 500, I'll break even 80%. Then 20% I'll take and maybe I'll buy into Bitcoin or put into Tesla, right? Because I know the likelihood that this will perform is very high. Then in the meanwhile, while in the next 5 years when I'm earning my cash inflow, right, I will basically just keep investing into my high conviction ideas like Bitcoin and Tesla. Because I know in 5 years, let's say every month I can save 2,000, right? 1 year is 24K. 5 years is 120K. 120K I invest into Bitcoin and Tesla over the next 5 years. I know that there is a 99.99, in fact, it's close to 100% chance, right, that I should be able to hit that amount in 5 years' time. Because if I started with 150K, I put 80% into S&P. In 5 years, the likelihood that 80% grows back into 150K is very high, correct? So this is how the way I think about diversification. I don't think about diversification in terms of money. I think about diversification in terms of time.
I really like how you are coming in from a different angle for the reason why diversify, because you actually have this quantifiable target, or rather like a financial goal to work towards, and hence that's why you diversify. But for most people, or rather like the lie that the financial institutes sell to the masses, which is to diversify, most people actually think the reason why they need to diversify is to actually mitigate risk, to de-risk their portfolio and all that. Like, what happens if you put all your eggs into one basket and you accidentally drop the egg? That kind of stuff, right? But like, coming back, I really like how you think about diversification, in the sense that I have this amount of financial goal or target that I want to reach, and hence that's why I am allocating capital in this manner, which some may find very radical, because that is the most efficient and slash safest way to achieve my financial goal. So when you put it into a sentence, right, and you think about the gain potentials, it actually doesn't seem so crazy anymore, because all of a sudden, right, the concentration is actually a calculated move based on sound logic basically. Like for me, for example, I am actually aiming to hit $1 million in my portfolio by when I'm 30. So I have to take rather so-called high-risk radical strategies to actually achieve that lah. So from my current portfolio value to the $1 million that I target, right, I actually know exactly how much I need to make in the next 3 to 5 years so that I can hit my target accordingly. And hence, that is why I place my bets accordingly, so that I purposefully experience exponential growth while I maintain my bets, which are not too extremely high in risk, but also have high certainty to actually hit my financial goals. So it comes to this juncture where you have to take a bit of risk to actually reach your financial goal, or you reduce your financial goal so that your exposure to risk is not as high. But in the end of the day, right, the deciding factor should not be risk, I feel.
Precisely. I would say that the way that I think about diversification, right, is I think in a manner of liquidity events. All right. Basically, when I purposefully, right, allocate money, all right, I want to be able to hit that target, right, with the highest level of certainty. Does that make sense? Rather than I just put money into a mutual fund, then pray to God that the mutual fund manager can give me that result.
I think you pray to hit the lottery even faster lah.
Yeah, precisely, which is what a lot of people do when it comes to like investing, right? They always put money into, let's say, a mutual fund, then they pray to God or they believe in the FA that it's going to hit that number, right? Without actually doing any due diligence, right? But the fact of the matter is, right, financial goals, the way that we grow your finance, right, is basically you need to have financial goals. So when you look at that particular target you want to hit, right, then once you have a goal and a target, the way you want to achieve that goal and target is through basically your income, through your investments, right? These are the two main ways that you can grow your money. You need a plan to generate income and you need a plan to grow your money, right? So assuming, let's say, your plan to have an income is really solved, right? Then the plan to grow your money should also correlate with how you're going to hit that goal, right? So it's like when you design a investment plan in terms of diversification, the way you diversify should not be basically like geared to like just protect your wealth. It should also be in line to grow it. Because I think a lot of people, especially in their 20s and 30s, right, they slip into this state of what I call retirement mode way too early. You know, they diversify way too much. When actually in your 20s, you actually had the longest runway to actually hit your goals as much as you can. Because in your 20s, you have a lot of time. You know, if you're 25, you easily have at least 40 years you know, to hit your wealth goals. And that's a very, very long time because, you know, you take a look at Tesla, right? Since they went public in 2009, they went from like 10 billion to now 900 billion. That's 900x in less than 10 years. So if you're 25, right, you can invest in you take a 5% bet or 10% bet of your net worth versus you put inside a mutual fund, right? You're taking that risk that in maybe 10 years, there's a possibility. Don't even talk about 900x, there's a possibility of a 10x, right? Versus you put inside, let's say, mutual fund, 100% you go into mutual fund, then you don't take any risk. I think the way that you're going to grow your wealth is basically going to be a slave to your income forever because you're still going to trade time for money forever and you will never let your money work for you in the long run, right? So like in terms of high level of certainty, right, we have done a lot of podcasts from episode 1 to episode 8 talking about the way to go and look for opportunities, so you guys can go and listen to that. But I think basically the crux of today's episode, right, is that we want to talk about diversification, right? Not simply in terms of just looking at your money 100%, then you allocate 20, 30, blah, blah, blah. But rather to give you the framework is that when you decide to put money down, right, basically the crux is you want to be able to hit your goal, right, with the highest level of certainty, and it needs to have that element of time, right? Because to hit $1 million, right, in 40 years, right, is a lot easier, right, than compared to hit $1 million like what Ryan say, maybe by the age of 30, because you left 3 years, right? The strategy cannot be the same lah. You know, I mean, if you want to hit 1 million ringgit in like by the time you hit 60, I think no, like honestly, I think most people can do it lah. But if you want to hit, let's say by age of 30, right, then how are you going to do it? Right? So you need to, so your strategy needs to be to correlate, right, with your time frame. Because for me, I'm also like Ryan, you know, when I started work, right, I wanted to hit 1 million by 30, right? I also wanted to do that. But I know through doing numbers in my head, right, if I work, let's say I get paid maybe 3.5, right? 1 year, I get 42. In 10 years, that's 420,000. I think, let's say I'm a super saver, you know, I save 80%. That's 320,000 over a period of 10 years, you know. So I know immediately, right, that I need 3 times that, right? And I also need to think, okay, in 3 times, I need to hit, I want to hit 1 million. I cannot just do that through doing this job. I need to do more than that. I need to invest my money. I need to generate more cash flow. You know, I need to invest my money more intensely, right? So you need to look at the ways you can navigate, right, to basically hit your goal. So it's like the main thing is that you must have a goal, and then apart from having a goal, in order for you to have urgency, you need to put a deadline. Because if you don't put a deadline, right, then there's no urgency. Then when there's no urgency, you will never do it.
Yeah, exactly. It's kind of like the report is due tomorrow, so you start working on it tonight, right?
Yeah, precisely. So when people say, oh, I diversify because I don't lose money, in my opinion, people diversify because they got no urgency. Correct or not? Because actually you think about it, people who diversify basically are people with no goals.
Yeah, that's quite true.
Because they don't know where they want to go. That's why they diversify, because they're scared to lose the money. Yeah, but people who have goals, especially financial goals, right? They want to hit a number within this certain time frame. They will take very calculated, decisive bets, do their homework, and then invest in things that they know with the highest level of certainty they're going to hit by this date. Okay, this is why we call it RA21, really adult show. Okay, because as an adult, all right, you must have goals and financial goals in your life. Because if you don't have goals, you don't write it down, all right? You don't have a time urgency, right? I can tell you from my experience, most likely you will not hit it one.
When you don't have a financial goal, right, it's kind of like just drifting through life. Because like most of the time when you earn like a sufficient amount of cash flow, right, life gets comfortable. And then you actually would feel like it's okay to live life the way it is until some shit happens.
Yeah lah. So this is why mutual funds, this is why mutual funds still exist. Because mutual funds, if you think about it, right, most of them don't have goals one. Mutual fund, what's their goal? You ask the fund manager, so what's your goal? The mutual fund tell you, we're here to basically just make sure that we give you risk-adjusted returns that's better than whatever you can put with your 99 other competitors, which are doing exactly the same thing. So if mutual fund managers are doing exactly the same thing as 99 other mutual fund managers, I can tell you most of them will not outperform one. Okay, you ask Warren Buffett in 1970 what's his goal. You ask him, this motherfucker, he can tell you, I want to build the biggest reinsurance company in the world, and I want to be the best in this. You can ask Peter Lynch as a fund manager what's his goal. All right, his goal is very simple. I want to find my 10x. I want to find my 10 bagger. I want to buy my 100. I want to find my 100 bagger. They are very decisive and very clear about what they want to achieve.
Yeah, there's just this level of certainty behind their goals and strategies.
And that's why they do unconventional things. Yeah, that's why they do unconventional things. When you talk to high performers, people who are at the top of their game, including fund managers, when you ask them what is their goal, they can tell you exactly what they want to do. All right, because they really roughly so that's why when you ask them why they have such concentrated bets in, like say you ask Warren in Geico, very simple, because this guy, he knows that he want to make sure that he buy this company and turn it 100x or maybe 1000x. They are very clear about let's say you ask a person who is into property, why they buy this particular property, why they want to allocate 50% of their income every month, cash flow, to take that risk to buy the property. Very simple, because this person has a goal in what he wants to achieve in this property. They can see, this property is, you ask a person like Stephanie, right? She can tell you this property is below market value. I can see when I buy this property, right, put money down, I know there's a high level of certainty, right, that this will become a profitable property because she knows the market, right? They will not tell you things like, because everybody is doing it, or I think I just want to, they basically just protect my money. They won't give you bullshit like that one. All right, people who outperform in money and in terms of investment, they're very clear. They know, they one look, they roughly know, right? They can tell you basically why they do it.
Yeah, and it's not like a lousy reason where they might go and say they cannot allocate to this stock because 10% is the maximum.
Yeah. So I would say, so that brings us to our next topic, right? Which is when should we concentrate?
Exactly. So to get this kind of outperformance, right? Like if you follow me and Aaron long enough, we are very heavily concentrated into Tesla and Bitcoin, myself particularly Ethereum, and arguably we have done quite okay over the last 2 years. So like, why do we do it, and more importantly, when exactly do we decide to start concentrating into a few assets? It's just exactly how we talked about this before. You have to set a financial goal. So we have financial goals for ourselves. We know that in X amount of time, I want to earn Y amount of monies, and hence that is why you expose yourself to Z amount of risk. So if I want to experience this kind of exponential growth to achieve my financial goals, I cannot put my money in a mutual fund or a retirement fund that nets me like 6 to 10% annually. Because at current economic climate, right, you can't even beat inflation with like 10%. And then aside from inflation, we are also thinking about like beating the S&P 500. And then after that, we are thinking about like the kind of gains that you get in multiples. We are not talking about like 20%, 50% gain and then we exit. We are talking about like how many times we can earn our money back.
Yep.
I think a lot of people will say this is quite greedy, lah. But then when you think about the probability, right, the certainty, which is very, very high to hit like a 10x or 20x, why would you not do it, right? And when you add on this time urgency, right, it makes me particularly understand that there is no better, more efficient slash faster way to actually do it, lah, to achieve my financial goals. So for lack of a better word, right, I'm actually thinking of earning money fast. But then again, I'm not gambling. I know my risk, and I'm only betting on stocks that have high certainty of helping me reach my financial goal within the time frame that I set for myself. Yeah, so this is how I think about time frames and when to actually start concentrating. That's because when you have like a relatively short time frame, then you have to take a more radical strategy to actually achieve your financial goal. So while we are on the context of like time frames, right, Aaron, what do you think is kind of like a healthy time frame to set for yourself when pursuing financial goals like this?
I think it depends on your personal goals, and also the money you put in, right, needs to correlate with your goals, right? So for example, like for me, I have a number I want to hit in 10 years. All right. So when I look at the number, and that number usually every 10 years, right, I want to add 1 0 at the end of my net worth. That has always been my goal. When I started at 20, I didn't want to add 1 0. I think when I start 20, I add 1 0, I think very cham. Right. I think I needed to add at least like at least how many? At least 3 zeros. Right. So I know that the first 100,000 is gonna be easy. Right. Because I know first 100,000 for me to hit in 1 year or 2 years, I can do it. Right. Because I do in my head. Easy, no problem. The difficult part, right, is after that 100K, right, how are you going to add that 1 0? Right? Because after the first 100K, right, the hard part is to the first million, you add 1 0, right, it is close to impossible. Because to hit it by 30, right, the amount of work that you need to put in if you just do it by income, right, just your cash flow income method, is going to be like hell on earth, right? You need to like push the bloody boulder up the mountain, very in a very like grueling method. You need to sacrifice a lot to hit. So immediately I know that number one is a healthy time frame, because I know when I started working around 21, right, I know I have 10 years to hit 1 million. So I know, okay, every year roughly 100K divide by 12, that's about 8.3 every basically every month. But I know that the bulk of it, right, will only come towards the end, towards the last 3 years of this decade, right? Because I know that the first 7 years, right, is about preparation. So basically, you just go back to a grind. I need to focus a lot. I need to solve the first problem first of the money equation, which is how do you generate income? I need to go and get a lot of skills to generate income. I need to prove to the market that I'm worth that type of income. So I go and find work, I go and find job, I go and do business, right? I go and do all that to basically get my cash flow inflow very high. So once I can prove that I can hit the cash inflow to the market rate, right, then I start to focus on the second part, which is how do I grow my wealth like a wealthy person, right? So how do you solve that? Very simple. Listen to RA21 podcast. So that's one way. All right. But I think the second way, which is a healthy time frame, coming to the question, right, is that when you the problem, right, that a lot of people have, right, is that the first one, how you generate income, right, this one, the results usually is quite immediate. Because when you change your job, when you do sales, when you do business, right, cash inflow is close to immediate. You can see 2-3 weeks, maybe 1 month, you will see the change in the money very fast. But the problem when it comes to healthy time frame in the second category, which is to grow your wealth, right, people need to understand, right, that the more you outsource your wealth to someone else to grow your money, right, the longer it is, it's going to take for that money to come back to you, because you need to pay for the time that the money goes out. Then once the money go out of your hands, right, earn the money, go and fight. Basically, you just think of a way like your money as soldier. You let your money go out into a while, right? Then once the money does its job ready, right, then it'll bring back more soldiers to come back to you to grow your wealth, right? So the thing is that, right, a lot of people get confused when it comes to the second part, to grow your wealth, is that they expect as immediate result compared to the first one, which is not the right way to look at it, right? Because when you look at the best investments through history, right, most of the time businesses do take time before they grow very big. All right, because the first 5 years of a business, right, the failure rate is about 80%. You stretch it out to 10 years, the failure rate is even higher. I think it's close to like 99%. All right, you don't believe me? You go and take a book, right, of the S&P 500 dating back to the 1980s. You just flip through the pages. Go and see how many of those businesses are in the S&P 500, which are the top 500 companies in America, of them are still existing. I can tell you, I think close to at least minimally 50% of them have been died already, right? All right, I can give you some examples. Polaroid, right? Kodak, right? These are some businesses which have already died or really merged or bought over by companies like Nokia is one of them. Ericsson still alive. Motorola, 50% of their business is dead. The mobile computing unit is dead. The only thing that's valuable in Motorola, which was Philip Fisher's favorite stock. Philip Fisher was one of the original thinkers of concentrated. During his deathbed, right, he only had one stock, and that was called Motorola. And the reason why Motorola was so successful till today, even Google, I think they bought over the Motorola unit. They bought it because Motorola had a very astounding R&D department, right, that focuses their cash flow on patents. Almost every single mobile phone today, right, uses technology that stem from Motorola's patent, right? So there's one story for another day, but basically, this is a very good example of time frame. In order for a business to grow to that level, even for people like Apple, even for people like Tesla, it takes, I would say, minimally at least 5 to 10 years for business to grow very big and very cash flow efficient. Right? You're talking about the business cycle. You're talking about the business cycle of the business, right? So that's why when you say healthy time frame in the realm of like growing of wealth through a business, right, it does require time. It's the results are not immediate. Like you cannot expect you to put, like, let's say for example, you decide to put in 10K, then that turns into 1 million in 3 months. All right. That is not going to happen. And even if it happens, right, if you're not ready for that growth, I can tell you, right, a lot of these people are going to lose their money, all right, very fast because they're not ready. They haven't earned the right to have that $1 million. And a very good example, you go and look at the last 3 months. How many people actually lost their wealth because they weren't ready? You just look at the last 3 months, right? In the crypto sector, you go and look at the OpenSea sector, right? The NFT sector. A lot of people lost their overnight wealth. Very simple, because they were just not financially ready for that money. That's why they lost it, right? So in a grand scheme of things, right, when you talk about healthy time frame, right, it's not just about the number in your bank account that requires a healthy time frame for you to be ready for the money. Mentally mature, in terms of maturity, in terms of mental maturity, and in terms of financial IQ, it also takes time for a person to grow into someone else who's ready for that money. Does that make sense?
Yeah, exactly. And also, like, when we go back to the part where you said building wealth takes time, right? I find like people in their 20s to 30s generally they fall into depression when pursuing wealth and like getting too eager to actually reach their financial goals. At some point, I'm sure a lot of you would have felt like it's almost impossible to actually get to $1 million in portfolio before you're 30 or something like that, you know. And to that, I would say like maybe you need to adjust your expectations, because like in the journey to building wealth, right, there's a lot of stages. Like what Aaron mentioned just now, you can go and increase your cash flow by upskilling, job hopping to a better job and all that. But at the same time, like if you are investing for the long term, right, you need to understand like all this exponential growth, it doesn't come in a day's time. It takes a very long time to actually build up in the initial years, and most of the rewards are reaped towards the later years when the exponential run up actually happens. So to that, right, for people in my age group, like still in the grind, I would say like try to manage your expectations and understand that some things that you do, like improving your cash flow, that reflects immediately. But like if you're investing for the long term into things like property, stocks, or crypto even, you know, it takes a very long time for the investment to actually play out, and hence, you know, you need to manage your expectations so that you don't give yourself this false sense of you're late or you're falling behind and all that, because like the fact is building wealth actually takes a very long time.
Yeah, and I think you brought up a very valid point, and that is when you basically my message to most of our listeners is, so long as you have a goal, right, and there's some level of like time pressure, right, you are already ahead in terms of a person who is on the trajectory of the growth. My mantra is, if you at least have a goal, even if you don't hit it, right, you will hit somewhere there. Does that make sense? But if you don't even have a goal, right, then you will hit nothing.
Yeah, it's kind of like the saying that goes, if you shoot for the moon, even if you don't hit it, you will land among the stars or something like that.
Yeah, but I would say that the keyword is healthy, right? Your keyword is healthy, and that is, look, I think most importantly, when you set goals for yourself, right, it should come from your inner self and not be basically goals that are dictated by someone else. I think this is very important when you do goal setting. Like, I don't think that most people are a lot happier if they have like 2 million versus 10 million. No, because I think beyond a certain amount, right, additional money is not going to improve your standard of living significantly, right? I think end of the day, when you guys decide to set goals, right, goals need to stem from inside, right? So, and then so long as, you're happy, then in my opinion, I think you're already better than most people who are basically like living day to day lah, right? I think end of the day, but I think the fact of the matter is, right, from my experience, most people, right, who so-called hit their goal, right, generally like the next thing, right, that they will do is to move on to the next thing, right? If you're a person who is very goal-oriented, right, let's say you hit this number already, right? Actually, once you hit it, I can tell you, you'll only be happy for about like maybe 1 or 2 days, right? Then you'll be happy. Oh, I already achieved it. Then immediately, right, because you're a person who goal-oriented, right? I tell you, within 3 days, you'll be a very restless one. All right, you're like, wow, well, this is it lah. Wow, this feels so underwhelming, right? So basically, then your next thing you want to think about is, okay, what's next, right? You want to go and do something else already. So I think there is some, they always say like goal setting, very high goals, unrealistic goals is a bit toxic, right? And my answer to that is the reason why a lot of it is very toxic is because a lot of these goals are not from your inner wants, right? Because if you have a goal that stems from what you really want inside, like you really like introspect yourself and think about it, what is it that you want to hit, right? Then I don't think it becomes toxic. It's only toxic, right? Yeah, you need to plan for yourself. I think that's something which you need to like really come to terms with, right? So long as you are working towards it, then I think it's okay. So on to the next topic, and that is why concentration is superior. I mean, I think this the best way to ask is Ryan lah, because Ryan, unlike me, right, you actually concentrate very early on in your investment career, right? So why is it that you feel that you actually decided to do that versus diversifying?
My answer is going to be a bit mundane, I would say, because the fact is, the reason why I decided to concentrate my portfolio was not because of the gain potentials. The gain potentials was something that I accidentally found out after I started concentrating my portfolio. So here's the funny thing, right? I decided to concentrate my portfolio because of minimalism. So at some point of time, I was actually investing in 3 different markets. So namely the local bourse Bursa in Malaysia, and then Wall Street at night, and then also the crypto. So basically, my eyes, right, were glued to the market 24/7, which was very unhealthy lah, basically. And it was quite difficult lah, I would say, because like morning you wake up, you need to read news from the local newspaper, and then at night you have to focus on Wall Street, and crypto runs on 24/7. And while you're working in the morning or trading, and then you still have to work simultaneously. So in the end of the day, like it affected my performance at work, which was quite bad. And so that is when I told myself I have to find a way to invest sustainably, put it on autopilot, kind of, so that I don't affect my work performance. And obviously, going by this logic, right, the first one that had to go was the one that had the same time slot as my work. So basically, I cut out everything from Bursa, and then I cut, and slowly I also noticed that I was following or investing in too many American companies, so I started to like cut them out because I don't want to read as much news. Same thing for the cryptos and the shit coins lah. As I started to trim out all these positions, right, the more and more concentration started to make sense, because like the fact is, when you start to trim all these positions, it's not like you decide to sell everything away on a whim. What I noticed was I started comparing the growth potentials, like which one will help me earn more money. And that's how I actually decided to trim out like all the stocks with relatively lower growth potential exponential. And then with the money that I got, right, I focused them on the ones that made me the most money. So that's kind of like how I reverse engineered the importance of concentration. And then as I started to trim and trim more and more, my portfolio got smaller in terms of holdings. And then well, like back in 2020, it was like a very violent, very volatile market, right? So like all these changes, it starts to reflect on your portfolio on like a weekly basis, on weekly to monthly basis. So like especially in Wall Street, when it starts rallying, you see like the gains to be quite very potent at that point of time. And I was wondering, right, at that point in time, after I made the shift into like just purely crypto and Wall Street, I was thinking like, what happened if I did not make the shift? And I started to back calculate, and that's when I actually found out that I might have lost 20% in terms of gains if I diversified in the 3 different markets. And hence, that's why I kind of like understood the importance of concentration at that point in time.
I agree. Like completely. Guys, this is why I like talking to Ryan, right? Because Ryan is smart enough to actually understand this in 2 years. It took me 10 years to understand this. Ryan understood it a lot faster than me. For me, it took like a damn long time to understand this. You know why? Because I read The Intelligent Investor and it made me unintelligent. So it's like, okay. So my take is right. If I want to outperform, all right, mathematically, the only way to beat an index, right, is to concentrate mathematically. Why? A 5% position, right, that gives me 100x, right? Let's say I have a portfolio. All right, I decide to take 5% position and this position goes on to 100x, right? This gives me 5 times my portfolio, all right, return, let's say, in 10 years. But if you actually like really look at stock performance, you will very quickly realize, right, that a company, right, a generational company that or idea that comes in, right, for it to hit 100x, right, in 10 years, right, usually this type of ideas are very rare, all right? And if you manage to find one and you understand that this is going to do very well, right, it really does not make sense, right, for you to limit your exposure, especially if you're in your 20s, right, to just 5%. It really doesn't. Why? Because this is what Ryan likes to say, which is to trim the weeds and water your flowers, right? Because if you manage to find a flower, right, the real way to do it is actually to water it and make sure that it grows into a tree, right? Because if you cut it too early, or if worse, you under allocate it, right, I think that is a very expensive mistake. Why? All right, for people who have done business, right, very simple. People who have done business, do business, or people in sales organization, all right, or even for those who don't, right, all right, you just go and look at the top 10 people 10 years ago versus the top 10 people today, right? I can tell you, right, in business, right, the reality is that people like to say, oh, American dream, I can go start from nothing, go be someone else, right? But the reality, right, is right, from my experience, winners, right, tend to continue winning, all right? In sales organization, especially, the top 10 salespeople, right, dominate consistently every time in decades and sometimes even generation, all right? Usually, you very rarely see newcomers come in, right, and then win the old timers, right, in terms of sales over a prolonged period. Maybe they can outperform maybe 1 year, 2 years, but usually after that 1 year or 2 year, they lose steam, right? Then usually they will not outperform, all right? The reality in business is that what I've learned is very simple. Winners tend to continue winning, right? And then people who are average, right, they tend to perform average. There's nothing wrong with that. That's pretty much like the life, because unfortunately, that's basically human psychology, right? So when I understand this, right, I understand that usually people who continue winning usually is a result of they have found a formula, all right, and there's a combination of formula, luck, all right, then they also have the right materials, right timing, so that's why there's luck. And that's not something which you can control, all right? And then they learn to scale, all right? And in a system of capitalism, unfortunately, most of the time, 20% of the people will be responsible for 80% of the results. Because in capitalism, most of the time, winner takes all. How many in the mobile phone category, when Apple came out with the iPhone, a lot of people tried to copy them and failed and died. Nokia, Motorola, Ericsson, right? I can name a lot. And how many of them are existent today? Only got three main companies: Samsung, Apple, and basically China. Right? The rest of them are all died already. right? So when you look at electric vehicles, isn't it the same thing, right? Tesla came out with the EV. Now every mother and father want to copy them. Also, it's always the same one. See, Apple, which is American. Tesla, which is American. The second category is China, right? And the third category are basically the old timers who want to catch up. I can tell you, within 10 years, right, 80% of them will die. Correct? Because it's basically the same. It's basically the same cycle all over again, right? When Henry Ford came out with the Ford vehicle number 1, right? Basically, Henry Ford dominated. There were about 3,000 different car manufacturers that came out. And about, I think, close to almost all of them died, except Henry Ford. Henry Ford is still available. GM, Henry Ford, and Chevron. Right, these are, sorry, is it Chevron? No, I think, I can't remember. That's the car, Chevy. Right, so there's only that's Chrysler, not Chevron. Chevron is the energy company. So Chrysler. So there's only like 3 main big companies, right, including General Motors, right, that which basically dominated the American motor company. And that's over a period of like 100 years. And then during the time when Henry Ford came out and produced the mass manufactured car, there were about 3,000 car companies. Airlines also the same thing. I think about, don't know how many thousand or hundreds of airlines were started, right? End of the day, a lot of them also died, right? So for every 10 years, right, what I realized when I read through all this, right, usually the ones that survive tend to be the ones who basically, from the very early stage, you can already see that they're winning already because they have momentum. This is the very powerful force in business that you need to understand as a business person. When you see someone with momentum, right, usually that momentum is very fucking hard to kill. Very, very hard, right? Because once the business has momentum, right, I give you an example, Apple. No matter how much money you have, $1 trillion, you cannot kill that business. You cannot, because it has too much customer momentum already, too much loyalty already. So how much money you have, you throw in it, you can never win.
This is why I like to say, like, on TikTok, right, you always see like people promoting Apple, and then it's the same thing with Tesla. Nowadays, like, kids are exposed to Tesla through TikTok. And like this momentum, right, has already been passed on to like the next generation. It's really cemented in their minds the fact that Tesla is the superior electric vehicle.
Precisely, that's why I say no matter how much money you throw at it, you can make the car cheaper, you can make the phone cheaper, you can give them the best tech. People will not switch because the momentum is just so fucking high. Get what I mean? So this is like business, when you think about it, right? Actually, the way I see it is very simple when it comes to investing. The best way I can invest, right, is to find a company with momentum. Because once I know that company has momentum, my business experience tells me, right, the likelihood that momentum stops is very hard. 真的是很难, right? Because when you think about it, business, right, is a reflection of human psychology, right? Winners, right, tend to continue winning, right? You go to any single business organization, especially sales, right, the top 10 salespeople usually are always the same. Very rare you see newcomer, very rare. Usually it's always the same people. So business is the same thing. The top 10 people in Forbes, right, usually are always the same people. Once in a while, a brand new generation of business comes, right? Example is Elon Musk. Out of nowhere, within a period of 3 years, he became the richest person in is it in the world? I don't know, is it in the world, right?
Yeah.
Yeah, in the world. He became the richest out of doing what? Selling cars. 5 years ago, right? 5 years ago, if you tell anybody, right, that fella is going to be the richest man on earth by selling cars, no one will believe you. But he managed to do it. Yeah, and that is a very good example of how capitalism works, right? Capitalism basically rewards the person, right, who's able to give 10x utility to everyone in the world by cutting 90% of the cost. That is the American way. That's why when people ask me why I invest in America, because that's the system. Their system is to make things very cheap and then give me 10x the utility. Right? You can look at all their innovation. It has been consistent throughout this trend. Most of the time, right, American, the way that capitalism works for them is that they jack up the utility by 10x and then they keep the price the same, if not make it cheaper by 10x. That has always been the American way, right? But if you go and look, yeah, that's how you change the world. You give them 100 times the value, right? Through innovation. Yeah. But after inflation, actually, you think about it, it's cheaper, right? Because the US dollar keep falling, right? Right, the US dollar keep falling. So actually, you think about the way it is cheaper, right? So I mean, like that's why when you ask me why concentration is superior, it's very simple. Because when I look at like simple business, right, I really realized over the years that good ideas and good business, right? Usually people continue to win. And then usually the average ones are usually continue to stay average. Very rare you start to see people, right, in average become like super winner. And honestly, if you give me a chance, right, to buy a winner versus an average, right, usually I'll buy the winner. Because over time I realize, right, usually very rare winners are selling themselves at a discount. Right? So if you are coming from a time frame of a value investor, you want to buy winners at a cheap cost, I can tell you 99% of the time they'll never be at a discount one, right? Unless it's like super black swan. And even in the black swan comes, I can tell you most of them will not buy. Because from experience, that's another human hurdle we have done, which is the all-in episode. That most of the time, people who say they're value investors, when it comes to actual execution, I can tell you 99% of them will not buy on when the market is down, right? How many, I give you a very good example. Last 3 months, market crashed by so much. How many of these people actually went in and buy? None, right? Very little, right? A lot of people all scared already, all don't want to buy. A very good example. You want to understand why? Listen to episode 4 on All-In podcast. This has nothing to do with rationality. This is about human psychology, right? And the way that I think me and Ryan has battled it in terms of human psychology is very simple. We just want to buy companies and business and investment ideas which are so good, right, that it has the potential to 10x, if not 100x, right? That basically all this noise, it doesn't matter. Because even if it crashed by 50%, right, we know the runway, let's say for a car like Tesla, is 20 million cars. That's 20x from today. So the way that I think it, right, is that Tesla today, 50 billion. 20x, that's 1 trillion. 1 trillion revenue, let's say net profit, 200 billion. I give a 20 multiplier, that's $8 trillion. Today, they are trading at about 900. That's about 8x. I don't have to think so much. My margin of safety, right, in terms of execution in the next 10 years is, assuming they don't hit it, right, I'll still get at least a 4 to 5x. Assuming that they hit it, right, I'll get at least a 10x. Right? So that margin of safety, right, in the future is so much that I don't really think so much about whether or not I'm paying 30% less, 40% less, 50% less. That's why you ask me why I concentrate. It's very simple because it's superior based on human psyche. Unfortunately, most of the time the winners, right, they tend to take 20% of the winners tend to be responsible for 80% of the results.
Yeah, basically this is the Pareto principle, right? Where 20% of your input is responsible for 80% of your output.
Precisely, and that actually functions in business as well. Because if you really like go down to the nitty-gritty of the S&P 500 in terms of like even decision makers, right, you realize that has been the case. That's why like when people ask me why I concentrate, I say because this is pretty much the reality, right? There's no point in me, right, being like Cathy Wood, right? Because like that's why we go back to our first point, right? Mutual fund underperform because they are forced to buy average, right? It's like you find something which is responsible for 80% of the result, right? Then you're forced to put 90% into other things which are average. So obviously you underperform because you're already structured to underperform, correct?
Yeah, exactly.
When you look at all their picks, honestly speaking, right, a lot of their picks the likelihood that they can hit their so-called objective is quite low compared to Tesla. Correct or not? I mean, like even a child can tell you when you tell you what did they buy? What streaming TV is that?
Roku.
Roku. You tell the child, you think in 10 to 15 years, this Roku thing will do well. Now the child also cannot tell what is Roku similar.
Yeah, some of them they may know Netflix and then YouTube, but most of them only know Disney Plus.
Yeah, so why you bother buying Roku, right? When you have Disney Plus and Netflix, why you bother? Because you think about it, like the risk for Roku is that they are fighting against Google Chrome. They are fighting against the TV manufacturer, right? They are fighting against Apple TV, right? They are fighting against so many of these like Mio TVs more, right? And then in terms of like the opportunity, then someone is a hardware business. And they're not like manufacturing their own shows, right? There's no alpha. They're in a hardware business, which is basically like a commodity. So if you give like Roku, right, versus like, let's say their business momentum, Tesla, why does it make sense? Like you give me Roku and Tesla, which one will you choose?
Of course, I'm gonna go with Tesla, right?
Yeah, precisely. So this is a very good example of why mutual funds cannot outperform because regulated by true regulation, right? They are forced to buy average. Get what I mean? So that's why you ask us why concentration is superior. You just use that framework on like business psyche.
Alright, so now I'm gonna play a little bit of a devil's advocate, right? And come back and tell you like all the fund managers would do, or the investment gurus, they will say, what happens if you put all your eggs into one basket and you freaking drop your basket? Right, I think in some sense they do make a pretty good point. So for example, I can give is that they like recently you see all the crypto startups going to zero, going bust, and like one of the examples is Luna and Celsius. And what I actually saw was like there's a lot of people who actually did went all in, and I feel a lot of like sympathy for these people, especially like the Celsius owners, right? Because the thing with Celsius is that you have to deposit your Bitcoin so that you earn interest in Celsius. And because it's kind of like fixed deposit for Bitcoin, right? What most people would think. So they think it's kind of like risk free, and then they put all their Bitcoins into Celsius. So unfortunately, the unimaginable happened, and basically Celsius went bankrupt, and gone is all the Bitcoin deposited. Yeah, so to that, right, concentration sometimes is actually detrimental. So what would you have to say about this, Aaron?
I would say that it goes back to our like abundance podcast which we did in the last episode, right? Where fundamentally when you assess that investment idea, you need to also look at the risk factors when you put money inside. All right. So I give you an example. Tesla. If I put, let's say, if I buy a stock today, what's my downside? Right, $50 billion company. All right. Downside, China remains closed. 7 factories. 7 factories. Assuming each factory manufacture 1 million car. All right, that's 7 million. Today they manufacture 1 million. Downside, assuming 60% is down, 3 million cars they manufacture. That's $150 billion revenue. That 3x from today. 150 billion, the revenue x even that still still shows growth, right? My downside at most maybe 3x revenue. That's 450 billion. That's a 50% loss downside. My downside is 50% if I buy Tesla today. What's my upside? They execute 20 million, 20x. I can get at least a 10x return on my money. So my loss is 50%. My potential is at least 10x. Will I take the bet any damn time? I'll take the bet because in 10 years, right, the likelihood that this bet goes in my favor is a yes, right? Because there'll be times where there'll be fuck ups, like basically the factory remain closed. But I know that over time, I know that the company will execute. All right, let me give you an example of why concentration is detrimental. This is when people fuck up. Seriously, they fuck up. Why? You look at Celsius, all right? You look at Celsius, what is my downside? My downside is the company go bankrupt and 100% loss, all right? 100% loss, I'll get wiped out. What's my upside? My upside, I get how much? 15%, 20%, 15% return per year, all right? 15%, right? But then, even with that 15% return, I still depend on the Celsius token price, correct? So if I cut that, right, it becomes 7%. So my downside is 100% and my upside is 7% conservatively, right? So this is my to get 7%, I'm risking 100%. Will I take that bet? Fuck no lah. Why would I want to take that bet? It's a stupid bet, right? You think about it. It is a very stupid bet because you're risking 100% for the 7%. Agree?
Yeah, and this is what I like to say to people who call me out for concentration, because like the fact is we don't take stupid bets, like risking 100% of our capital just for 7% in interest. We don't do that shit. The bets that we take are all very calculated bets. It's not that I don't understand the risk that I'm taking. It's that after I calculate my risk, right, I understand that the trade that I'm going into has more certainty and probability for a 5-10x upside versus a 100% wipeout. You get what I mean? As what Warren Buffett likes to say, diversification is for the ignorant. So like when these people they diversify, right, they are not aware of like the inherent risks. Like let's say people diversify across the S&P 500, right? So 500 companies. But it's not to say that there is no risk to all the 500 companies that are within the index fund. There's just like this S&P 500 board that regulates the 500 companies. And when they see signs of like certain companies dying, they weed them out and they bring in some other company into the index. And because of like how effective the S&P 500 board is, right, a lot of people actually fail to understand the importance of the S&P 500 board. They get very complacent and say that this is probably the most stable investments of all time without actually understanding what are the underlying mechanisms, what are the kinds of regulations that actually go through to ensure this kind of stability in the index. And also, like, I'm not sure these people actually notice that like the top 20% holdings of the S&P 500 are actually responsible for 80% of the gains of the index funds. Yeah, you would probably earn more money by focusing your funds on the top 20% weightage of S&P 500 and outperform the S&P 500 index fund. At least that's what I think.
Because they are the best risk-adjusted ideas, right? Because the fact of the matter is, right, if you actually, I posted on my Instagram, right, in 2014, the revenue growth of Tesla, Nvidia, and Domino's Pizza, right? 3 completely different industries. You look at the revenue growth relative to the valuation, right, in my Instagram. And you very quickly realize, right, that they all got to their returns, right, in a manner that's very different. Agree? Tesla, when you look at their sales growth, I was stupid enough, right? To not actually look at Tesla seriously in 2012. Because now, on hindsight, when I go back and look at their revenue growth, my jaw dropped. I was stupid enough to not catch it early, right? When I look at Nvidia, I wouldn't buy. You transport me back to 2014, 2015, 2016, I wouldn't buy, right? Because this is a cyclical stock. It's a cyclical. Because you look at their revenue, right? They even had revenue drop, then revenue flatline. Then suddenly out of nowhere, their revenue 5x. Agree? You look at Domino Pizza, their revenue actually only grow by 8%, right? But the reason why they were able to outperform FANG is because their multiple went up by 10x because they were trading at 30% revenue, right? How many companies are growing at 8% actually trades at 30% revenue today? You can't find it, right? You really cannot find. So I'm just saying that, give you an example is that there are many ways to earn that alpha, right? Peter Lynch is very famous for investing in cyclical. When he got that 29% return for over 14 years, right? He did it by actually investing in, if I'm not wrong, it's Moto. It's also a vehicle company, if I'm not wrong. And then he basically traded cyclical, right? So that's one way to do it. The other way is to buy generational companies. When you take a look and study like Tesla, you go and study Apple, because these are what you call generational companies, right? So the detrimental part, right, is that I think it becomes very dangerous, right, when you wrongly assess the risk, the potential risk, right? Which the very good example is like when you look at Celsius, right? A lot of people forget, right, that the likelihood of losing 100% is very real. It's like, for example, I give you a gun with 100 loaded, the barrel, Russian roulette. I give you a gun, right, with 100 bullets inside, right? And basically 100 chambers. I just put in 1 bullet, right? There's a basically, then you put it at your temple, right? You fire it. If it doesn't go off, right, I give you 1 million. But if it goes off, you're dead, right? A lot of people, right, was actually doing that with Celsius. They basically, the Celsius, the idea is like that. There's 100 barrels in the gun. You have 1 bullet. That bullet just need to go off only, right? The entire project die already. Yeah, and the problem is, guess what? The bullet went off. Agree? So a lot of people, right, they forget, right, when they actually assess the risk. The most important question you need to ask, right, is whether or not you can lose 100% of your money. Because that is like the worst case scenario, right? You need to ask that question. So when you ask that question, right, if there is a possibility of that, then you need to assess what's the likelihood. What is the likelihood of the maximum damage? What's your maximum damage, right? When you can assess your maximum damage, right, then you roughly calculate, okay, like for example, I just give you my Tesla example. My maximum damage is 50%, right? Worst case scenario, maybe 80%, but I still have 20%, right? So if I know that's my maximum damage, right, then this is when diversification comes in. I do not put 100% in Tesla. I diversify it into other ideas. I buy Bitcoin, right? I buy moonshots, right? I buy Ethereum. I buy Palantir for future growth, right? This is when diversification makes sense. Because when you do that risk assessment, you know there's still a chance where it can go off, the bullet will hit you and you die, right? Then you use that risk management and then you diversify it into other ideas. Because if you have, let's say, 3 or 4 ideas, right, with the potential to 10x or 20x or sometimes 100x, right, you just need one idea to execute, right? You make back your money already.
And that's what basically a moonshot is, right?
Yeah. So when you talk about why concentration is detrimental, that's why you cannot put, like when we say you cannot put 100% of your eggs into one basket, sometimes it's due to basically the person, they assess the risk wrongly, right? They're basically playing that Russian roulette analogy I gave you. right? And that's why, for me personally, no matter how good the idea is, right, I never put 100% into that idea. Never. Because I know there's always a very small chance that it will go off. The bullet will go off, right? I don't know why it can be a black swan, right? So that's why I never put 100%. So what is the best way I can do is very simple. I diversify through my income source. I diversify through my ideas, right? I put 33% here, 33% here, 33% here, right? But then these ideas that I put in, right, all of them have a very high chance of getting that return that I want. It doesn't mean that when I diversify, I go and buy like a mutual fund. It doesn't mean that. Basically, I just diversify into something else, right, that also has an equally high likelihood of achieving what I want.
So this is the Warren Buffett and Charlie Munger play, minus the management part lah.
Precisely. And also another way where I can say that concentration is detrimental, right, is that you can buy value investment. Right. For example, you see that this investment is like 50% undervalued. It's not growing, it's dying, right? Then that's when you have a lousy industry bias, right? So a very good example is that during the COVID shutdown, right, I had many people come up to me and ask whether or not they should buy SIA shares, Singapore Airline shares, right? A lot of people, hey, should I buy SIA or not? I tell them, I say, you like the airline industry a lot. Number one, I say you like SIA, you like airline a lot. I say, do you know that the airline industry is a shit business? Number one. And number two, I say COVID. I say, what's the likelihood, right, that the airline business, right, even if let's say they recover, they're going to be a very good business for you as an investor to earn money, right? So I think the point is, right, if let's say you are in a very high, let's say you have very good energy, let's say you are a very high performer, right, in the company that you work for, right? The problem is, right, no matter how good you are and how high performing or high functioning you are, if you are in a fundamentally shit industry that doesn't pay well, even to the top 20%, right, you are simply just not going to outperform on a global scale. Does that make sense? So this is what you call bias lah. This is what you call bias, right? Because sometimes concentration is detrimental, right? Because sometimes you need to assess, right, your position in the value chain. If you are a customer and then you're getting a lot of value from Grab, the winner is the customer. The investors are the losers in Grab. Agree? If you are an investor, you will not want to buy Grab because when you look at their balance sheet, it's a shithole. All right, you look at their finances, walao. As an investor, I really cannot put my money inside because number one, structurally, the Grab business model, you go and look at Uber, right? They're also bigger. It's a shit model for an investor. It's like hell on earth like that. All right. I'm never going to make my money back. All right. The whole game since the beginning of Grab and Uber is basically to keep raising money for them to have an exit at IPO.
Yeah, that's the thing with like Uber, Grab, and like Lyft, right? They are all the same. Their goal is basically for the venture capitalists, the VCs, to actually exit whatever growth they experience. They experience before the IPO already.
Precisely. So I think it comes back to the question when concentration is detrimental. It's very simple. When you as an investor decide to start a position in something, right, the fundamental question you need to ask is whether or not the industry itself that you're investing in has good economics, right, in favor of the investor. That is a very good question you need to ask. A very good example of investments or industries that has good economics in favor of investors. Okay, you can look at the FANG stocks. Facebook, Amazon, Netflix, Google. All right. Okay, you might argue that they're flat and running growth, but the truth of the matter is, when you look at their net income, right, it is very favorable for the investor. All right. Yeah. What are some industries, right, where it's a shithole for investors? You go and look at industries in the meat processing industry, the public companies of food manufacturing. Their margins are 2-3%. They're already it's like 2-3%. All right. And then they are like hell on earth lah. Really cannot make money one. Because it's like a marginalized business, right? Then their gross profit is like what? 20%, 10%. Then after tax, it's like, wow, this type of business, it's like, why would you want to buy it, right? So it's like, you really have to sit down and then ask yourself whether or not the business can make money as an investor. But sometimes when you study this, you realize that inside the value chain, you just want to place yourself, right, inside the value chain where you can basically get the most benefit. A very good example is, as an employee, sometimes that business, right, rewards in the value chain the most to the employees. sometimes it's the customer. The customer, some very good examples I can give you are the ride-hailing business. Anything that to do with transportation, in terms of the public transportation, utility is one of them, right? Ride-hailing is one of them, and of course, airlines. These are very good examples where the customer actually has the most benefit. But as an investor, you better don't put your money over there. You rather go and put inside places like Apple, places that has higher profit. Even places like Microsoft or even Oracle, that's still better than putting your money inside utility and like airlines. All right. So that's when like concentration becomes detrimental. You are so focused on like what you think is logical, right? But then you forget to ask the major question, hey, this industry profitable for me or not as an investor?
Yeah, I think this is where a lot of people fail to be critical because they are sometimes consumers of the product, right? So they like the company a lot. They think the product is great. So naturally, one would think that great product equals to great economics for the company slash investors. But when you actually look at the financial statements, the balance sheets, you would actually understand that this is a black hole.
Yep. So that's one very good way to look at it, right? So you ask us why concentration is detrimental. I will summarize it as three main reasons. The first is risk assessment. You do it wrongly, right? There's a chance to go 100% down, and then you don't believe it or you delude yourself. So the risk, your risk assessment is just wrong. The second thing is basically bias. All right, your bias into industry, which is just terrible for the investor. All right. And the last one, in that particular aspect, I guess you need to determine, right, when you look at this investment idea, who is the ultimate winner? Preferably, all three needs to win because that's how you get generational growth. But I would say that, if one is benefiting against the other, then generally that business will something which will not succeed over the longer term. Because eventually, right, if investors don't make money, eventually that business, right, will not get funding in the long run. That business you'll end up going bankrupt. No business can function. Yeah, no business can function perpetually, right, on a loss without going bankrupt. A very good example of industries that do this consistently is the airline business. During COVID shutdown, a lot of airline business went bankrupt if they were not able to get funding. All right, you just go and look at just search it up. A lot of them went bankrupt. All right, so the next thing that we go into diversification, right, is the illusion of being smart, right? This is something which I add inside, all right, because I realized over the COVID period when a lot of people were very keen on investing, right, is that they all come up to me, right, and basically ask whether or not this particular business is good, that particular business is good, this particular business is good, and then I call this the Gay Kiang paradox, right? Why I call this Gay Kiang paradox? Very simple. Because a lot of these people come out to me, right? And basically their investment thesis, right, is like instead of like buying Tesla, they decide to buy a company that do EV, right, in a certain country I shall not name. All right. And they like to root for the underdog, okay, instead of buying the winner. All right. This is what I call Gay Kiang paradox. All right. From our explanation of business psyche, right, winners continue to stay winners. It is very rare, right? In reality, as much as we love the David versus Goliath story, that David actually, it's very uncommon for David to win Goliath. Okay, because as I mentioned earlier, the moment the business has momentum in terms of branding power, in terms of sales, in terms of having a super loyal customer base, right, it's very rare that you see underdogs rise and overtake the winner. This is something which unfortunately is very rare, as much as we love David versus Goliath. Right? And this is what I call Gay Kiang paradox. Because instead of buying the winner, which is a very obvious thing to do, they like to look for small companies, and then without thinking, right, whether or not these small companies can outperform in terms of management, in terms of momentum. Because most of the time, these small companies are the reason, they are undervalued for a reason. Because most of the time, a lot of these companies, right, if you actually like look 5 years, 10 years ahead, right, honestly, I can tell you a lot of people cannot really see whether 5 or 10 years or whether or not the business can survive. Agree? It's not just EV, even in NFT, even in crypto, right? During the boomtown Charlie days when crypto was at $69,000, right? You go and look at the crypto space on Twitter. A lot of these people, right, came out and said, oh, this is going to change the world. That shit is going to change the world. Then you go and look at this coin, see me, stupid lan jiao coin, right? You can honestly tell me in 5 to 10 years this coin will survive. I can tell you, even the people who create this NFT, 99.9% of them, they acknowledge that all of these coins will go to shit, right? So if you know that a lot of these coins are going to shit, right, then why would you still gay kyang and then put 100% of your net worth inside this whatever shit coin or shit idea? Why not you decide to put 80% of wealth in ideas, right, when you know with a very high degree of certainty, right, within 5 to 10 years that they are going to execute the idea?
It's just for those people who don't understand the word Kie Kiang, which is Hokkien. In Cantonese, we call this To Ye. In Chinese, we call this To Si. So in English, it roughly translates to acting smart or faking that you're smart. So basically, like for in the context of investing, you think you know it all, you're so smart, and then you go and buy into something that you don't fully understand, and then in return, you get burnt. So that's kind of like the gist of it. It's a funny story that I can share, right? So during the rally, the bull market 2 years ago, in the mid of like 2020, right? Or when everything was like recovering, everyone was like, damn Kiang. Now, they even walk up to me and tell me, oh, this CEO, I think he should be doing this. If it's not like he's missing out, that's why I'm going to sell his stock. And what happened? The rally of the century happened. In the context of crypto also, right? I feel that like Geikyang in particular destroys people's lives a lot. Because like sometimes when you have like some new shiny consensus mechanism or like some new shiny stablecoin that you can stake with and get like 100% dividends or yield APY or whatever, some people, they jump into it, and like if they actually sat down to think about it, like where the money came from, like how are they paying out all this so-called APY or the yields, they could have like actually avoided the mistakes.
Yep.
So yeah, there's like a lot of examples, right, where Geikyang will work against you. It's okay if like you Geikyang and diversify and then you miss out on gains. That's fine, because that's not like a life-threatening mistake. But then on the flip side, if you Geikyang and you go and concentrate, right, on the wrong asset, wow, I tell you, you have to be like dead sure when you concentrate that like you have like a level of like certainty that you know that with high ass probability that this stock, right, can actually 10x or like 5x. You have to be very sure when you like concentrate on a single stock or an asset lah, because like if it backfires on you, you will actually see like 50% drops, 70% drops, or in some cases where some people get too cocky, they go and leverage, then they will probably lose out everything. So to be sure that you have like a very good understanding of whatever you're buying into, right? I would say to this, go and talk to people, like just kind of like to verify that you have like a good understanding, because like when you have like a fundamental understanding, not just on the surface level but also on like a deeper level, you when people ask you questions, right, you can just answer it on the fly. You don't have to think too much. It doesn't have to be like a perfect technical answer, but as long as you can keep the answer logical and then you can explain it so that the other person understands it, then effectively you can say you understand the trade. So I guess the crux of the matter here is that when you buy into an asset, right, not just a stock or crypto or like any commodities, when you buy into an asset, you have to understand what are the inherent risks that comes with the asset, not just the business model or the consensus mechanism of the crypto, but you also have to understand what kind of asset now, like in the financial tool kind of context, you need to understand that, is it leverage, is it a CFD, because like some of these positions, even if it's underlying, it's like a stock or not, you might get wiped out if the exchange decides to wipe it out. So let's say you understand the risk, right, and now we talk about risk taking. So sometimes when you take this kind of like unnecessary risk, the risk to reward ratio has to be like justifiable, when you have a chance of the stock going or like the crypto going to zero, then it also on the flip side has to have the potential to go 100x, not just 10x, we're talking about like 100x, because the risk you're taking is too much already. And also when we talk about like the context of the potential of to lose all your money, like what we talked about in the moonshots episode, right? You want to diversify at this kind of like investments where the investments will go to zero. You know, you want to keep the position very small, just like 5% of your portfolio, and then you know, you still have your main holdings. Like for me example, I have my Tesla, Bitcoin, Ethereum. Those are like my main holdings. The ones I gamble with are, you have to acknowledge that this is a gamble, where your DeFi can maybe go to zero. That's when you limit the position to just 5% of your portfolio. So even in the case where it actually goes to freaking zero, you lose 5% of your total portfolio. And tomorrow when Bitcoin goes up or Tesla goes up by 5%, you recovered. Simple as that.
Yeah, I think so, because like um I think that's why when we say the illusion of being smart, right? I think sometimes as what you say, I think the key thing that you said is that you need to be able to honestly you need to be able to honestly acknowledge the risk of your investment at the downside. Because a lot of people, right, they only look at the upside, but they never acknowledge the downside. And that is something which is very dangerous in investing, because as you have rightfully mentioned, right, you lose money and capital. And that is something that can be very, very expensive, I think, over the long run. Like for me, right, I can give you some examples. I've made investment mistakes in my life, right? But these mistakes have never bankrupted me at all. Why? Because whenever I put money into a particular project, the first thing that I always look at is what is my risk, right? So the reason why I have never gone bankrupt in things like super high risky positions is because I've always sized my positions properly, right? Because I know that my downside maximum 50, 80, sometimes 95%. But it didn't hurt me is because I size maybe 1 to 5% of my net worth, right? Whereas I have my core positions where basically the core position just need to double, I already earn back my 5%, right? So that's when, and also roughly the main reason why I put this the K-Kiang paradox is because I think end of the day, right? I've learned over the years that people try to overcomplicate investing. That's from my experience. They really overcomplicate it, right? Then when you see all this like so-called advertised guru who make money more from your causes than from investment results, right? You really realize that actually overperformance in investing, right, is not, say, it's simple, okay, but it is tough. Because what is very expensive is the psychological acknowledgement, right, that it is simple, okay? Something that is simple doesn't mean that it is easy, okay? There's a very fine line of difference. Simple to concentrate, but very difficult to execute, right? Because in exchange for that simplicity, you need to be able to trade of emotional volatility in the market. You need to have the stomach to see volatility such as 50% drop, sometimes 60%, 70% drop, which a lot of people cannot pay. And that's why they decide to basically buy mutual fund. Because mutual fund, the job of the manager is to make sure that they try to be as stable as possible. And in exchange of that, right, you basically, the cost of hitting that 1 million is 40 years. All right. So, I mean, this is what we mean by K-Kiang paradox. People try to root for underdogs when obviously there's better risk-adjusted returns in terms of looking at the winners. So, I think end of the day, this particular point, I just want to say that basically, as much as possible, try not to K-Kiang too much. You need to be able to acknowledge that investment can be very simple, but it's not easy to execute. All right. And how do we weather this volatility? And that is basically our next point, which is what I like to call this Mr. Murphy. All right. Why? Because from my experience and looking at personal balance sheet, right, this is when Mr. Murphy will come and fuck you, right? Because Murphy's law is that whatever can go wrong, right? That's called Mr. Murphy, all right? So in your life, right, how do you best protect yourself against from Mr. Murphy, all right? This is a concept, right, from Dave Ramsey, all right? And he says the best way to avoid Murphy's law to come and fuck you up is to make sure that you have an emergency fund, all right? So the best way to avoid emergencies, right, in case where you need to dip into your investment fund, is to have an emergency fund. Because if Mr. Murphy come and visit you, if you have an emergency fund, you'll be okay. Agree? So yeah, so that's the way that I solve it, because I realized over time, right, that actually I do not need a lot of cash for emergencies, right, personally. So I know that in order for me to avoid this, right, to let's say I need to liquidate emergency needs, let's say hospitalization, let's say I kena some illness that I for some reason over the last month I kena some illness that the entire world is being like very worried about, right? How do I best fight against it is to make sure I have emergency fund, right? Because when I have this, right, I can focus on recovery instead of focusing on whether or not I earn money, right? So having an emergency fund, I would say, is the best way, right, to fight against this, right? But the problem is, right, that a lot of people, right, they overestimate how much emergency fund they need, all right? Because it is not uncommon for me to see, right, for people who have allocation of 90% of their portfolio into emergency fund. It means they hold 90% cash. It's not uncommon for me to see that. I would say that a lot of financial advisors, I wouldn't be surprised, right, if they actually ask their clients to open up their balance sheet, that 90% of it is in cash, right, and they don't invest the money because they're so scared, right? But the problem is, right, if you actually really do down the numbers, and from my experience, right, the major life events are things like life, death, disability, illness, hospitalization. All these, right, can basically be hedged through life insurance or insurance matters, right? And these insurance are usually, right, your premiums, as a rule of thumb, right, is between 5 to 10% of your cash inflow. So if you pay 10% of your cash flow to protect yourself against insurance, right, that actually gives you the ability, right, to basically not have such a huge emergency fund. Use that fund that you have accumulated to actually invest at least minimally in the S&P 500, right? At least minimally in the S&P 500, right? And this allows you, right, to basically utilize that money. Because the way I see it is that the longer the cash sits in your balance sheet unused, right, the opportunity cost of that is at least about 7 to 10% per year, right? I think the best example is you look at your Malaysian ringgit. If you had held Malaysian ringgit for the last 10 years, right, and not invest your money, your Malaysian ringgit has depreciated by 30% over the last 10 years, right? Okay, actually, it's even more because everything in Malaysia increased in price. So not only do you have to deal with depreciating Malaysian ringgit, you also have to deal with increase in prices, right? Your price is at least, your property price 10 years ago, at least went up by 50%. So if you are basically a Malaysian, right, you hold 90% in cash, and then you don't invest your money, basically you are really losing a lot of money in terms of opportunity cost. And basically over time, you're going to realize, right, that wealth is basically just dropping in terms of purchasing power.
So yeah, here's the thing, right? For emergency funds, right, most people actually hold them in like fixed deposits, cold hard cash. Like basically, they put it into fixed deposits, so they earn a bit of interest here and there, and 100% they won't lose the money, right? But then, for me personally, I put my emergency fund into Bitcoin and I hodl it for like over a year or two. So now that after it has its run out, right, even if I decide to sell, like just say maybe I have like a emergency of like say 2,000 ringgit, then I sell 2,000 both of Bitcoin, then I wouldn't really feel it still, if that makes sense.
I would say that end of the day, right, the emergency fund, whatever structure you choose to do, even if it's like Ryan's case, or my case, the way I do emergency fund is very simple. I use credit card because I know the credit limit that's given to me, right, within 3 months I can pay off. So honestly, it doesn't even make sense for me to hold much cash, right? It actually it is in my favor to hold some debt, right? So for me, the way I structure it is my emergency fund, I don't even have cash because I know that assuming, let's say, I need emergency fund, I use my credit card to pay. Within 3 months, I can clear it, right? Because I have enough. Basically, I can get my shit together in 3 months. Liquidate some of my investments, like what Ryan say, right, and then pay it off, or either drag through that from my cash flow, right? But I think the most important thing that an emergency fund does, or at least have a strategy for emergency fund, is that it allows you to be rational when it comes to moments of shit happens. I think that's the most important thing that a person needs to have in terms of that emergency fund concept. And they need to be, they basically like, have that moment where you need like immediate liquidity needs, right? You need to have the ability to make decisions out of that you need to make decisions that is rational and not out of urgency. Does that make sense? Yeah, you cannot be in a position, right, where you need money, right, and then you make decisions out of desperation. And that is what an emergency fund strategy gives you. It gives you the ability to make decisions in a very rational and calculated manner, and a manner, right, where it does not affect your future wealth growth to your detriment. Because this actually happens, unfortunately, because times like this, right, touch wood, things like illness, right, honestly, you cannot predict. Because sometimes when it happens, right, it really happens, then really you got no chance to gonna all this, right? Then basically, you'll be in a position of vulnerability in terms of your wealth. Because assuming, let's say, you are like me, 125% invested, right? Right. And if you don't have a contingency plan to buffer that 125%, such as your cash flow, your insurance, if I gonna, let's say, cancer tomorrow, right? If I don't have insurance, I'm fucked already. Correct. Because hospital bills will come in, then I don't know whether I can work. If I need to go for chemo, I don't know whether the next 6 months to 12 months I can actually think about focus on recovery, right? When I have a high volatility investment like Bitcoin and Tesla. That's why, for me personally, I hedge my bets through insurance. Right. So this concept. So I would say that in a way, right, when people talk about risk, right, the reason why I say emergency fund is a mental structure, right? It's not just because of that usual 6 months to 12 months type of emergency fund. Emergency fund, the deeper you go, right, can also basically mitigate your risk through life events that are not within your control. Things like cancer, things like hospitalization, or even for Ryan's case, even last month, right, he kena his car maintenance, right? Yeah, so that's a very good example of risk management, because sometimes things like this happen not within our control, not that we want it, but it happens. So I think you'll be in a very vulnerable position, right? If as we say, you focus everything into one and then you don't prepare for things that are not within your control. So the reason why I want to add this inside this particular podcast is because I also think it's very important that we prepare for unforeseen circumstances to the best of our ability. Right? There's no way we can predict 100% everything, but to the best of our ability, right? When it's cost efficient, we just prepare for it.
So from this, I'm getting two things. One, which is basically to have like a stack of cold hard cash, not too much, just enough to make you feel safe. And the other one is to actually have like a strong cash flow so that you can rely on your credit cards to actually make the payment first, and then you pay back the debt in the following months.
Yeah. In my particular case, right, what a credit card do is that it buys me time. Does that make sense? Yeah. So what it does is actually, for me, the way I look at credit card is just not money. Because the way I look at currency is not how most people look at currency. I look at money as time. Does that make sense? Because I know my monthly expenses is how much. So I know my freedom in terms of currency value. So assuming, let's say my monthly expenses, let's say, is about 3,000 Sing dollar, right? So every single $3,000 I see is 1 month of freedom. That's how much time I value that 3K. So the way I look at credit card, right, is that assuming, let's say, I have a credit limit of, let's say, 30K, right? To me, that is 10 months of time. So that the way I look at emergency fund is not the way conventional people look at it. I look at it as time. So I think end of the day, right, it goes back to the fundamental principle, right, is that you need to have emergency fund contingency, right, where you are not placed in a position of desperation and vulnerability when shit happens. That is not related to your investment performance. It's just a matter of life events. It can be your car breakdown, it can be touch wood, COVID, touch wood, job loss, touch wood, all this type of unforeseen circumstance that, will force you, to basically make decisions on the detriment of your portfolio, right? Because the way I see it, if I need to liquidate, let's say my Bitcoin, right? Let's say I need to liquidate $1,000 for immediate needs, right? For me, it's not $1,000, because I know that in let's say I liquidate today 1K, right? I know that decision cost of liquidation of 1,000 within 10 years that becomes 20,000. So for every $1,000 I liquidate, to me it's not 1K, it's like 20K down the drain. You get what I mean?
Yeah, this is exactly what I feel every time when, I have an emergency and I need to kind of sell my Bitcoin to actually fund the emergency. It's quite painful, honestly. I'm also hoping for a better way to do this emergency funding without holding too much cash. So in your opinion, right, the better way to actually do it would be to actually leverage on your credit cards.
Yeah, I don't think there's a 100% foolproof method to do it. I think each individual person just need to do it right in a way and a manner that they can best deal with it, right? You know, some people, they are comfortable selling their investment. For me, I'm not comfortable doing that because to me, every time I sell, alamak, 20K gone. For every $1,000 I liquidate, it's like, shit, 20,000 gone. You know, so when I think of that, right, it's too painful for me to like sell, you know, because I don't really want to liquidate. So what I do is that I do it through credit card because I know at least credit card is not my money and I can pay it off. I can pay it off in 3 months. You get what I mean?
You know, you mentioned it's actually quite a smart way to go about it.
So, so yeah, it's not my money. It's okay. And then you know, hopefully in 3 months, maybe the money that I borrow, the currency goes to shit. You know, so that's the way I do it, lah. You know, I don't think there's like a real 100% foolproof method to do this. You know, but I just think that you need to be able to be prepared for life events that will happen that is not within your control. Because most the way from experience, right, what I've noticed is people who don't prepare for this, right, eventually when the thing happens, they are forced to make decisions that are out of desperation.
Yeah, and I think like this would usually bring you towards a very bad mistake, right?
Yeah, it's very bad and very expensive.
That's the thing, right? I think a lot of people my age don't own insurance aside from like myself, right? I have like the insurance that's covered by my company. But aside from that, I don't have like a insurance to cover myself. And I think like a lot of us are clueless when it comes to like the so-called premiums and what to cover. So in a nutshell, right, could you actually give us like a rundown on like what kind of like insurance that we should actually buy into?
There's only really like three death, disability, and illness. And basically, I tell all my clients and my friends, right? I say the premium you need to pay maximum 10% unless you got health condition. So usually the premium, right, is about 5 to 10% of your annual income. All right. And then the coverage you need for death is 10x your annual income. Coverage for illness is 5x your annual income. That's it. Right. I just basically gave you like the guidelines, right, for 99.999% of you in terms of insurance coverage. 5 to 10% of income, 10 times for death, disability, illness is 5x. That's it in 2 sentences. I don't know why so many people overcomplicate it. You need to like do projection, all this. Actually, insurance is a very simple one. That's pretty much like the guideline.
I mean, it's kind of like we are uneducated, right? Like most of the people out there, like laymen, we are uneducated about like insurance. And when you ask young people, like what kind of insurance we want, we don't know. We are uneducated on it. Like we don't know exactly what we need also. And then when you meet like all the salespeople, right, they take you one whole round around the world, so it can be like extremely daunting when they throw all the jargons here and there. And like, yeah, you know, that's why I guess people complicate insurance. For some people who don't know better, they end up with like premiums of 20-30% of their salary, which is crazy. You know?
Oh, that's very high. 20-30% usually means that your insurance is not efficient.
Usually, how many percentage of your income you would call efficient?
Usually, my guideline is 5 to 10%. That's it. Yeah, 10% is on the higher end because that usually means that the person has underlying health condition. But if you're in a healthy health, right, everything is okay, your cash flow is okay. Usually, 5% more than enough.
All right. I guess we can move on to our very last topic of the day, which is basically what happens when diversification goes wrong. And in a nutshell, in the investment community, we like to call this diversification. Right. So, Aaron, what are your thoughts around diversification?
I would say that it goes back to our summary of basically the last 7 points we talked about, right? Which is like, if you diversify without having a very clear reason why you are doing it, all right, then it becomes diversification, right? The reason why I added the emergency fund point inside is because I also see it as a diversification strategy in my portfolio. Does that make sense? Because I know that I need to be prepared for emergency liquidity events. And that's why I diversify with a strategy, right? A person who basically diversify, right? A very good example you can see is a lot of mutual fund. Okay? And the prime example is Cathy Wood, right? She diversify not because she wants to, but she has to, right? So when you diversify, right, just because someone else is telling you to do it, I don't think that is a very good reason why you should spread your eggs or, spread your eggs around. Personally, the way I see it is that you diversify, right, with very clear goals on why you are doing it. If you cannot explain why you're putting money in this particular portion, right, to diversify, then honestly, you are diversifying because you're not doing enough due diligence, right, and thought as to why you are deliberately doing this. Okay, that's why it becomes diversification. Because if you cannot even like answer the question why you are doing it, right, then the likelihood that you do well inside this decision, right, is very low.
What I notice with people who diversify, right, is that most of them they actually do it out of fear of the unknown, basically. Like for example, right, if you diversify through the S&P 500 index fund, then basically it's a nicer way of saying I am enabling myself to be ignorant of the 500 companies that I've invested into. In general, I don't think there's anything wrong with the S&P 500. I think it in terms of like diversified products out there, I think it's pretty much the most efficient one out there. But if you invest in the S&P 500 or any diversified fund, right, you have to manage your expectations to expect less gains than what individual shareholders will experience that, basically, because that's how the game works, right? And when we talk about like the institutional investors, right, like Cathy Wood, she has both her hands tied up. She cannot invest more than 10% into a single individual stock, and hence like I see a lot of the financial institutions, they sell the word diversification as much as like their loan department sells the phrase in real estate, which is to why are you paying for people's mortgages? It's basically the same thing, because like diversification out of fear and risk mitigation is basically limiting yourself to like higher gain potential. The fact of the matter is, all these financial institutions, what they want is for you to buy their fund. So they sell you the fact that it's diversified, so hence it is very safe because there's less risk, which is all pure bullshit. Yeah, and that's kind of like why I just want to put it out there, right? The fact is that diversification is a strategy. It is a strategy that you execute with purpose, not because out of like it's out of like fear or like risk mitigation. Like I'm not sure why most people regard diversification as part of like a good portfolio when clearly it's holding them back from like all the maximum gains they can actually get. When you diversify into something else, right, you have to ask yourself whether like by making this move, this trade, does it actually hold me back in terms of the maximum gains that I can get? Because like most people, when they diversify into another stock, they diversify just because they think it's safe, like it's a defensive stock, blah blah blah. But in the end of the day, they net like a 1% gain. They can't even beat inflation. So it really begs the question, what's the point, right? Like the problem here is not that you cannot diversify. It's okay to diversify, but most people diversify without actually understanding what they are buying into. They might be buying into the next Luna, they might be buying into like a dead value stock, and then they call that safe, right? Not always more is merrier. And for example, right, I know we've been bashing on like Cathy Wood a lot lah, but when you take a look at like the number of holdings in her ETF versus like other ETFs, right, like the S&P 500, the reason why she could outperform in 2020 was because she only limited like the number of her holdings to 30 or 40 stocks at one time, and then the other ETFs they go to like between like 50 to 100 stocks. How can they outperform Cathy Wood? And if we follow this logic, right, less is more, right? On a retail investor level, sometimes I see people set up like email alerts and notifications on like 30, 40 different companies that they buy into. It's crazy, These people wake up, they look at emails of some company statement that they don't really understand of, and then they have to keep reading it every day on top of their own busy schedule. Like, come on, you ask yourself, is that really the life you want to live or not? Like personally, right, when I cut down and limited myself to just 10 stocks to begin with, what happened was I freed up so much brain space and time to actually focus on what really mattered, which is for me Bitcoin and Tesla and Ethereum basically.
I agree. Okay, to clarify something, we are not bashing Cathy Wood per se, but we are bashing actually like the whole consensus of the mutual fund industry that actually forces mutual fund managers to diversify, right? I think if you actually like follow Cathy Wood, right, what you realize that the reason why she outperformed in 2020 is because of her allocation inside Tesla, right? And that's a very good example, right, of 20% of the position is responsible for 80% of the result. So actually, if you had basically just followed her best idea, right, you would have gotten at least 3 times of what she actually returned in 2020. All right. So, and actually, if you go even further, right, actually what you realize is that actually Tesla, even though they had a drawdown, also outperformed the S&P 500, right?
Yeah, that's the thing, when people see the drawdown, they immediately lose their mind, but they forgot that they are actually still up. I did this plot of the S&P 500 against Tesla year on year starting from last August. So basically what happened was Tesla had like a 30% outperformance against the S&P 500. And guess what? The S&P 500 is down 6%. So if you add everything up together, maybe you round it up, you get like a 40% outperformance from Tesla.
Yeah. And not only that, they actually even outperform Fang. Yep. So, I mean, this is what you call very good example of diversification, right? Because you'll very quickly realize, I think, when you really put a lot of conscious thought into investing, right? And that is diversification cannot come out of fear. Does that make sense? You cannot do it because out of fear. Fear cannot be the driving emotion for you to diversify. When you diversify, right, it needs to come from rationality. And that means, right, that you have done your math, you have done your assessment, and you have decided that this is the way to do it. Because based on your assessment, right, you realize that this risk needs to be diversified away, right? So you're not diversifying, right, because of regulation, right? And I'm not blaming Cathy Wood, right? She's actually quite good in terms of, I think, her thought process. It's just that, unfortunately, she chose the wrong vehicle to invest, personally. All right. She is bounded. Her hands are tied. She's handcuffed to a chair and she cannot do anything because that is the regulation of basically mutual fund. She's not the only one. Okay. Other mutual funds also cannot whack. All right. So, unfortunately, this also goes back to our bias. On why concentration is detrimental. And it's very simple because that particular industry, right, has very shitty economics to outperform.
She's bound by regulation.
Right? That's like the mutual fund. So I'm not bashing her, I'm bashing the industry. All right. So coming back to the diversification, right? And that is why when you decide to put your funds as separated, right, it needs to be very clear and strategically why you're doing it. Like I think some people, they invest inside real estate, right? It's because they know that the cash flow from real estate is more predictable than the cash flow from, let's say, a REIT or even like wealth portfolio growth. So I think that's a very good example of why diversification makes sense, because they want to basically have more dependable cash flow coming in. All right, that is not diversification. Even if your results are lowered, right, because of that, right, I don't see that as a negative, because I actually see that as a positive, because that mental freedom that comes with certainty, right, actually allows you to perform better in other areas. So I think we have pretty much covered all the 8 points of our podcast. So now we'll go to the Q&A.
Right, so this time around, we've got like a couple of great questions from Instagram. So the very first one is how corporations structure their portfolio to retain wealth.
Yeah, I think I'll take this one. How corporations structure their portfolio to retain wealth. Okay, I think you are not specific as to what type of corporation you're talking about, whether or not you're a business or a portfolio manager. All right, portfolio manager, the way they retain wealth is very simple. Just increase the AUM. So they increase the marketing, put in more money, and continue to charge you 1 to 2%. Unfortunately, even you can underperform, but your portfolio manager, you can still continue running the portfolio for 10 years, sometimes 20 years, even if you underperform. So that's why I don't really like mutual funds. Whereas you're asking in terms of like business, right, how they structure their portfolio, it's very simple. Usually as a business person, right, I think your biggest risk in business is that you are not prepared for the next 3 to 5 years and you underinvest in your business, right? And this is very prevalent, right? When you go and take a look at some industries which failed to change, and they end up being forced to change. And if they are not forced to change, then they end up dying, right? A very good example is you can take a look at the music industry. A lot of people basically got screwed by the wave where basically Apple decided to open the iTunes store, right? Then a lot of this like small publisher, they basically got kicked out of business. Then a lot of this like music stores that sold music CDs, right, DVDs, a lot of them died, right? Blockbuster, then in Singapore, there's a lot of like this a very small DVD store, CD store that basically rent DVDs or even sell DVDs, a lot of them went out of business. All right. A very good reason why they went out of business and they lost so much wealth is because they were just simply not prepared to basically force themselves to change in the next 3 to 5 years. So retaining wealth, in my opinion, right, is not enough for you to actually retain it. Because I think what I have noticed over time, right, is that the only way where a person can really truly retain wealth is that they actually have ongoing growth mentality. Meaning, no matter what, even if you reach like financial freedom, financial security, if the moment the day comes, right, where you stop taking risks and invest for the future, that is when, right, your wealth will start to decline. That's what I learned. In looking at many portfolios, looking at many corporations, looking at many businesses, the day that the person, right, stops investing for the future with a growth mentality, right, is the day that the business is basically on route to death already.
I mean, it's kind of like logic, right? You would have to be relevant in the future to be able to maintain the wealth.
And not just retain, but also grow in tandem with your competitors. Because over time, what you're going to realize is that sometimes instead of being the hunter, you become the hunted in business. Right. And in order for you to defend against that, right, you need to come up with ways where you can stay relevant, as what you mentioned.
I can give an example from the investing industry. So basically, again, Warren Buffett and Charlie Munger, right? These two and Berkshire Hathaway, they are always aiming for an investment into the future. So, for example, 10 years ago, they invested into BYD, the EV maker slash battery maker in China. They also invested into multiple different clean energy companies around in the US. So that was like way before everyone thought like ESG and EV was a thing, right? And at some point, their growth started to flatline, which admittedly, I think I also thought the same. Basically, I thought they stopped growing really because their investments were all like Apple and all the big tech, like kind of like flatlining, But then that couldn't be further from the truth because like in the last few quarters, you could see it. Their renewable energy investments paid off tremendously. But the fact I'm trying to get to is that it's because they invested into all the futuristic investments like the BYD and the sustainable energies, right? That's why they had like a nice 20%, 30% run up. If they haven't done that, right, they would probably be flatlining along with like big tech and also maybe even dropping, I don't know. But the moral of the story is you kind of like need to keep evolving to be able to compete in the business space, like, if that makes sense.
Yeah, of course. In fact, it's pretty much like the case, lah, right? So when you look at like all these corporations, I think the main question I always ask, right, whether or not what are they doing for the future? That's always my main question when I look at corporations, right? When they structure their portfolio, even if you're a mutual fund manager, right? Because if their strategy is basically just to maintain, the force that is going to kill them, right, is two things: capitalism and inflation. Because if your business is not growing at least in tandem with inflation, right, what's going to happen is that over time the business will decay and die, right? So, to answer the best question, right, the corporations, the structure for portfolio, the unfortunate truth is that they need to spend money, invest money to grow. I don't think retain wealth is really a good way to look at it, because I think retaining wealth, eventually the wealth will not be there, because you're going to basically it's just on route to irrelevance, right? So our next question is why ARK ETF is the 21st Century Cramer Co. Personally, I think we've spoken enough about this, about ARK ETF. And personally, I don't really see Cathy Wood as a villain, unfortunately. I just think that, actually, I still think that what she says has a lot of relevance. It's just that, unfortunately, right, the regulations in place make it very, very difficult for mutual fund managers to outperform in a prolonged period, right?
So here's the thing, right? Cathy Wood, she basically has tremendous understanding of like the EV sector. So that was basically what made her wealth, right? Tesla. So if she could, I think she would have dumped like 60, 70, or maybe 90% of all her funds into Tesla. But because of regulations, she cannot do that. And hence, that's why she needed, or rather forced to diversify. And this is where it gets a bit tricky because her funds team is like disruption, innovative disruption, right? So like you need to go into like the different industries to actually find what's actually doing all the cost cutting and like 10x improvement in terms of technology and stuff like that. And like arguably, like to understand a certain industry, it takes a long time. And not saying that she doesn't understand, but like maybe, there's like a lack of understanding when she goes into these disruptive industries like genetics and all the game engines and all that. So what happens is that she started to buy all the underdogs. So for example, she bought Unity, right? And then Unity is kind of like an underdog when compared to Unreal Engine. And then she bought Roku, which is also an underdog compared to like Netflix, that kind of thing. So she's picking a lot of fights that she actually like don't understand well, I would say. And by buying all the underdogs, this is what we like to call 给强 lah, basically.
Yep.
And the sad part is, right, she still has to stick with her ETF's theme, which is what we mentioned just now, the disruptive innovation, right? Which I mean, at first, it sounds really cool. I also bought the ETF out of like admiration of her. But then the fact is, like, statistically speaking, right, disruptive innovation doesn't come that often.
I don't think there's any way you can find 50 names off the bat of your head, right? That is going to like disrupt 50 industries at one time.
Yeah, exactly. Like even if she actually does find those companies, right? The chances of these companies actually changing the world, it's like another totally different probability really.
Precisely. It's like you're not even sure whether they can execute. They have an idea, but execution is something which you're not sure whether or not they can achieve, right?
But like in defense of Cathy Wood, I feel like she's not stupid. She just picked the wrong vehicle to execute her ideas, basically. If you actually follow her, you would also know that her views on macroeconomics sometimes can be quite accurate also lah. It's just very unfortunate that she's got both her hands tied by the regulations.
She's basically like, the industry is just structured to make sure that you get worse results, unfortunately.
Yeah, it's kind of sad. But anyways, on to the next question. So we have how to find a suitable index fund for risk-averse investors. Here's the thing, right? Like personally, my appreciation for index funds actually came after I started investing in individual stocks. So like why most people go for index funds is probably because they want to avoid volatility, which all the individual stocks will have, right? And it's kind of like a backwards thing, I started investing in like one of the like Tesla and like Bitcoin, and then I look at S&P 500 and I was like, wow, the stability is just superb. But to answer your question, right, I feel like over here you are talking about like volatility lah. And volatility, the tolerance to volatility is very relative. It's like some people can take like 70% drawdown, some people cannot. 2% already they start freaking out, and to that I say try to get used to it lah. But personally, if you ask me for something that's like risk adverse, right, I would like for myself lah, like if I'm looking for something like that, I would go for the S&P 500 index fund. How about you, Aaron?
I've always repeated this to many people. All right, you want higher risk and higher potential return in a manner that's autopilot, then you buy the what you call it, the NASDAQ, right? But if you want diversified, risk adverse, best performance, and you're going to win 99% of mutual fund managers, you just buy the S&P 500.
Yeah, exactly like what Aaron mentioned, right? The S&P 500, it beats like 98% of the fund managers out there. What's not to celebrate, right? All you have to do is just buy one fund, and then you do it in a manner where they will ask you to do it for like another mutual fund or the so-called robo-advisors, which is basically you dollar cost average into it every month, a set amount, and you keep doing it over and over again for months. But in the context of passive investing, right, you have to be careful about the fees lah.
Yeah, to add to the Ryan's point about fees, right? When you buy an index fund versus mutual fund, right? The index fund cost per year is 0.05%. All right. The cost of the mutual fund is at least, right, if I'm not wrong, 30 times higher than mutual fund. If you prolong the alpha, right, in terms of cost difference, the alpha, right, you're already starting, right, mutual funds versus index funds. The index fund already give you a 20% head start. To translate that in terms of time required for the mutual fund to catch up baseline with index fund, it costs you 5 years time. for the mutual fund to catch up in terms of fees for versus the index fund, right? Yep, correct. In terms just for the fees alone, just the fees alone.
But when you start doing passive investing, right, that's where you have to be really nitpicky about like the fees, lah, like what Aaron mentioned. So like even between the different ETFs, right, you would have to analyze which one would be more beneficial to you, which one has like lower fees, which one has like less tax on like dividends, you know. If you're interested, you can actually go look up for Z Invest and his analysis on like the different ETF products out there for the S&P 500. I think towards the end of his analysis, the best one he found out was actually the CPSX. I'm not sure about that.
Yeah, the Irish one has lower liquidity, but the benefit is that you don't have to pay. I mean, you have to pay, but the taxes for the dividend is lesser compared to the VOO. Yep, I think we can move on to the next question. You should or should not diversify in current market. Explain both plus opinion. I'll answer this first. Whether or not you should or should not diversify in current market. Personally, I'm basically just investing into my highest conviction ideas, namely Tesla and Bitcoin, 50-50. I don't diversify in all markets most of the time. My investment career, right? I started out as a person who diversified, but over time, I realized that diversification is simply not the right way to invest for me personally. Okay, because I learned over time, right, that if I want to outperform, and especially if I'm a active investor, right, I need to concentrate my bets. That's why I don't diversify. What I do diversify in is not in terms of position, but in terms of time. As what we have explained, the concept of the mental framework, how you diversify. Like, I know that in 5 years, I need this money. I will diversify the portion of my wealth into a vehicle, right, that has the highest likelihood of achieving that number in 5 years, right? But if I know that I don't need that money for 20 years, then I will diversify the money that's required for 20 years, maybe 30, even 40 years in a vehicle that's going to best perform in that time frame. So when people talk about diversification, they talk about in terms of percentage of money. I don't look at it that way. For me, the way I look at diversification is percentage of my time. So for example, this year I am 33, right? So, I just gave everyone my age. So in terms of like the next 40 years, right? I know in the next, so if I say 10 years, right, that's 25% of my time. So, okay, this 25% of my time, I need to allocate a portion of money what I don't need for the next 10 years, 25%, and then put it in an idea that's going to best perform in 10 years. Because the truth of the matter is, right, each investment idea has time frames, right? Innately, you know, right, when it's going to be best performing. You cannot precisely answer like when it's going to happen, but you can roughly estimate, right, in 10 years, the likelihood that this happen is very high. So each investment idea has a particular time frame, right, where you can break even and make the exponential return.
Yeah, that's when like the company passes the tipping point and starts to scale exponentially, right? But in the first few years of the company's foundings or like the company's IPO, like say Palantir, right, you would have to be prepared to backhoe a bit lah. You might suffer like 50-70% losses, but believe that you come back up whole, and then once it passes that tipping point, you would start to see that exponential upward trajectory lah, basically. But in terms of like whether you should or should not diversify in current market conditions, right, I think macroeconomics and like the market condition shouldn't be like the driving factor or like of your decision whether you should or should not diversify. As we mentioned just now, diversification is a strategy that you utilize to your maximum potential. Most people are diversifying just because fund managers diversify because they're forced to, and I think like the biggest edge like any retail investors have is to actually concentrate lah. So honestly, no matter what market condition is in the backdrop, if you ask me whether you should or should not diversify, I would frankly tell you to concentrate.
I think we have answered this. We can go on to the next one. Europe, China, India, Japan, Singapore, over index. Which will we choose? I think both me and Ryan have pretty much like answered this repeatedly over our channels, and that is we invest in the American market most of the time. I think largely I can chime in, and through my experience, right, I've always thought, I mean, I used to buy the dream of undervalued sectors around the world. But then when I combine that ideal, right, it's idealistic, versus traveling across the world in places like Europe, China, Japan, and even I'm a Singaporean, so I stay in Singapore, right? I just do not see that level of speed. The key here is the speed of innovation, right? And wealth trajectory as fast as America. And this has been quite consistent in terms of and when I say speed of trajectory of not just innovation but wealth, right? I mean it, right, in terms of the perspective as a foreign investor. Okay, the key word here is foreign investor, because sometimes, right, you can be in a country, right, there is a super high growth, you participate in the economy, right, you can make a lot of money in that country. But I think the difficulty, right, is that there is a difference between making money as a local versus making money as a foreigner, right? So that's why when people ask me like all these particular countries, right, why I don't invest in them, it's because very simple. I have not really found another country, right, apart from America, right, where I can make money as a foreigner effectively, predictably, and sustainably. Because almost every single time, right, where a person or when I've seen a person, right, try to invest money, let's say in a foreign country apart from America, right, the difficulty is not making the money. The difficulty is getting the money out of that country. And that is what I've learned over the last 10 years. Because I have clients all over the world, right? I have some of them who go into the places that's been mentioned, China, India, Japan, right? And Europe, right? And what I learned is that getting money out is something which I feel that America, in terms of being foreigner friendly, right, is very good at.
Yeah, that's actually quite true. When you look at the dividends, right, the Americans, they tax their own citizens for dividends, but they don't tax the foreigners.
Yeah, so I mean, this by itself is the reason why I choose America primarily as my investment vehicle. And personally, also the main reason is in terms of language barrier, right? I think having a country that speaks English and I'm fluent in English, right, makes things a lot easier for me to keep up. Because if I invest in a Japanese company, right, my Japanese is sibei jialat, right? I cannot read Japanese. No, I can speak elementary level Japanese, but my Japanese is not so fantastic that I can read a financial report in Japanese, right? If I invest in China, right, my Chinese language even more sibei jialat, right? You ask me to read a Chinese report, I cannot even read like primary school level Chinese. I can speak, I can understand, all right? But you ask me to read a Chinese report, right? I can't do it, right? So, I mean, end of the day, it's about your natural advantage. So people ask me why I don't invest in Europe. I say, because I've been to Europe. I like to be there as a tourist, but I don't like to be there as a business person. All right, because I personally, so from my observation, it's a good place to relax, right? But I think in terms of like speed of innovation, right, America is better.
I mean, just think about it. Europeans, they have the best work-life balance. So when you clock off at like 5 and you go have wine and you don't work overtime, how are you going to change the world?
And I think you just need to look at evidence in the last 20 to 30 years, right? I think most of the innovation does come from the US.
Yes, exactly. When we talk about like innovation in the 80s and 90s, you look at especially in information technology, IT lah. You look at America, right? Everything is from America. Apple's from America, Microsoft is from America, and like in the 2000s, Google is from America. Like all the big tech, they all are born in America. I mean, yes, sure, Europeans are quite fast in like adopting all this technology, but then the fact of the matter is the inventor, the creator, they are all from America. And I think like in this context, right, one of the ways to look at like which country to or not to invest in is to actually understand like world politics basically, and also the world order as Ray Dalio likes to call it. All right, I guess we should move on to the next question.
The next question is, are you into commodities? This is a bit arguable because Bitcoin got classified as a commodity.
I mean, is it a commodity? I don't know.
Yeah. The American regulators classified Bitcoin as a commodity. So I think in a way, I guess it does function like a commodity.
Yeah, I guess you could classify Bitcoin as a commodity when you think about the scarcity which is inbuilt into the tokenomics of Bitcoin.
But I don't think we both actually see it as a commodity, rather as a store of value, which is like largely different from what you would think as a traditional commodity. Because when you think about like traditional commodity, right, you're talking about things like oil, gold, silver, things that are basically like the fundamentals of like building blocks of like materials and goods and services, right? So I think technically speaking, I don't think we invest in commodities because I don't really see Bitcoin as a commodity, rather as a
Technology?
how do I say it? It's like I think the best way to explain it, right, is like it is a decentralized monetary system, all right, that has its own rules and regulations that is free from political intervention.
The key word here is political intervention.
Yeah, because honestly, as much as a lot of politicians like to say, oh, we're going to ban Bitcoin, then BlackRock, like 3 years after bashing Bitcoin, told everybody yesterday they're going to let all institutional investors buy Bitcoin, right? I wonder who didn't see that coming. So, like as much as they like to bitch and complain, that they're going to ban this shit, shut down the mining, etc., right? The truth of the matter is, if you actually really understand like Bitcoin, right, and the ledger, it is really like to the way I see it, is basically like an alternative form of monetary government that cannot be altered by anyone. And that idea itself, in my opinion, is a lot more powerful than giving your power, right, in terms of your wealth, into a entity or in a country, right, where the government overnight, right, can basically dictate that this particular property zone is no longer applicable for residential use.
Basically, with a stroke of a pen, on a damn paper, right, your investments could be nullified just like that, because when you think about it, like, especially like for the heavy metals and like oil and gas especially, right, you're basically, if you're buying into these commodities, you're leaving your fate up to like the people like OPEC, and you don't know what stupid shit the OPEC's gonna do tomorrow, Yeah, so basically it goes back to the stoic saying of like, don't try to control what you cannot control, right? Basically, all these commodities, they are all very politically linked, and they are based off decisions of very important people. So essentially, when you're buying into commodities, what you're doing is actually predicting what these important people will do next, which is close to impossible to actually predict. I mean, okay, it is something that's up for debate, but it's definitely not up for debate for the retail investors. It's something that the world leaders do. It's not for the retail investors, if that makes sense.
And I think end of the day, in terms of alpha from commodities, is really about demand and supply, right? So and I think in terms of demand supply, nothing actually wins Bitcoin in terms of that. So I think I guess we can say that we do invest in commodity, which is basically Bitcoin, but I don't really see it as a commodity. Like if you really go like deeper, if you want to understand why, right, and our framework, you can just listen to our podcast. I think in episode 1 and 2, episode 1 and 3, the fiat standard and why we invest in crypto, New Hope. Yeah, that's our 2 episodes which we did on this, right? So the next question is, will diversifying different types of assets generate more return, holding a couple of stocks in the long run?
It depends, I think. Like, what kind of assets are you actually buying into, or are you diversifying into, right? So, if let's say you're diversifying across like a few different shit penny stocks or shit coins in the crypto space, then probably not. But if like you are diversifying across like different asset classes, say like me and Aaron, then we are heavy onto Bitcoin for commodities, so-called commodities, and also a Tesla for stocks. Then yeah, because we are still very concentrated in the different asset classes. But I guess the keyword here is still being heavy onto a single or just one or two different assets.
I think end of the day, I do feel that this is what I noticed. My observation is people who concentrate their efforts, right, tend to perform better than people who try and diversify. I think this is true in terms of your career, I think this is true in terms of your relationships. I think this is also true in terms of your investment and asset portfolio, right? Because I think something which most people don't seem to understand is that when they concentrate into a particular, let's say, stock like Tesla or Berkshire Hathaway, I think what they do not seem to grasp, right, is that within that particular company itself, the manager of that business, right, tends to also diversify in that particular business. Does that make sense? So, for example, if I buy Berkshire Hathaway, right, 99.9% of my wealth is in Berkshire. Do I really need to worry so much about diversification when Berkshire Hathaway owns more than 300 companies and businesses? I don't really need to, because that business itself is really diversified, right? If I buy a business like Johnson & Johnson, there are so many patents, there's so many business skills, there's so many like different type of business. So even if the Johnson & Johnson family, almost 100% of their wealth, right, is concentrated in Johnson & Johnson stock. Do they really need to diversify and buy S&P 500? I don't really think so. Because that particular business is diversified enough. Agree? So when you ask me like diversification, even if I put like 80% of my net worth inside, let's say Tesla, or 100% into Tesla, Tesla itself is a business of businesses, right? They own many, not just cars, but they also own R&D departments, right? That also has a runway and roadmap for product lines in the next 10 to 20 years. So you ask me,
They also own the supercomputer to train the AI. They also own the machines to make the machines, basically.
Yeah, precisely. So it's like a collection of businesses, you get what I mean? So even if, let's say, for example, I have 90% of my wealth in Apple, 90% of my wealth in Amazon, this particular business that you buy itself, inside there, you open up the business, right? It's so many different business, right? I give you a very good example. Apple. The Apple, if you separate away the entire Apple company versus the AirPods, the headphones category, right? That headphone business itself is worth at least 25 to 40 billion dollars as a IPO. You get what I mean? So when people tell me like diversifying different type of asset, right? Sometimes I think you need to go deeper and realize that even if you have concentrated wealth inside singular businesses, right? People seem to forget that the business itself also have multiple businesses inside.
I think a better way to actually go about this is to think about how vertically integrated the company is. Because for the fact of the matter is that most companies, it's very important to diversify their business in the sense that like for Tesla, for example, right, they were actually forced to diversify out of like just making cars because they had to actually learn how to make some of the parts that go into their cars because they cannot rely too much on the supply chain, because when like there's like a say supply chain disruption and whatnot, all their car parts going to be delayed and hence their car deliveries will be delayed, and that doesn't translate well for the revenues. So generally what you actually notice from these business owners, right, particularly they diversify because they have a need to diversify. They have a problem to solve somewhere, hence they have to deviate from their focus away from their main product so that they solve the problem to keep the main product going. It's very much unlike the fund managers. They diversify just because of the sake of diversification.
Yeah, precisely. So it's like, so to answer the question, will diversifying different type of assets generate more return than holding a couple of stocks in the long run? I think ultimately, right, I prefer to actually outsource my diversification to my concentrated positions, places like Bitcoin, places like Tesla, because I know that when they buy a business or when they diversify, so-called by acquiring different businesses, right? Usually, the way that acquire businesses has a lot more multiplier effects than me as a person buying a business. Okay, a very good example is you take a look at Facebook. Facebook spent $1 billion buying Instagram 10 years ago. They bought Instagram for $1 billion. Back then, right, Instagram, basically, they basically say it was a crazy, insane deal to buy Instagram for 1 billion because they weren't making money. 10 years later, do you think that Facebook has made more money? What do you think is the valuation of Instagram today? They make back their money, right? So another very good example you can look at is Google. When Google bought, I think YouTube, right? I think Google paid, I think 300 or 600 million dollars for YouTube back then, right? Today, what is the valuation of YouTube? How much money does YouTube make for Google every single year? I think you can just check the balance sheet and check the revenue statement. I'm pretty sure I don't even need to check the numbers. They're making at least 10 times that from at least 5 times 5 to 10 times of the acquisition price for YouTube in terms of advertising costs, right? So whenever people say that diversify, I always prefer to let my ideas diversify themselves because I just know that they're just going to do right by the business. And when they acquire businesses, they're not thinking in terms of like protecting their wealth. They're thinking in terms of multiplication effect. So when I buy 600 million, I invest in this business, right? As a business person, I don't really care about like 5%, which is 30 mil. Right. As a business person, when I acquire a business, I want that business as much as soon as possible, return my money within at least 1 year. And if possible, right, the valuation 10x within 5 to 10 years. And I can do that because as a company like Tesla, I have people who can better manage the business when I acquire them.
Yeah, exactly. Like there's a lot of different examples in the business context of where you have all the stocks and everything. Like again, Amazon, AWS, and their main business, which is Amazon.com. But like in the crypto space, right, there's like another example I can give you. So basically, it is Ethereum, right? As some of you may or may not know, Ethereum has a very extensive ecosystem, wide enough to cover a lot of things. So all the buzzword that you hear on the crypto space today, like NFT, CBDC, and smart contracts, all the new tokens, DeFi, all that is actually running on Ethereum. It's on the Ethereum network. Majority of them, like maybe 80% of them. So why would I bother with buying like a lot of the shit coins that say that they're going to challenge Ethereum sometimes when like they have already such an extensive ecosystem with such a dominant position in the crypto space? So yeah, that's right. All right, I guess this answers the question. So we can move on to the next one, which is how can an average Joe start besides relying on one source of income, or how to gather that courage and take the first step? Aaron, do you want to take this one?
I think everybody starts with one source of income because that's the easiest step, right? I think I did it, right? And most people do it. But I think the courage part itself, I think we best explain it in episode 8 in terms of abundance mindset. And that is, I think over time, what you're going to realize, right, is that many people really undervalue how much they can do if they set their mind up to it, right? Because a lot of people, I find that they don't really like utilize their talents to the maximum potential. And I think end of the day, right, it really comes down to really like having enough confidence in yourself, develop that belief in yourself, right, that you are worth more than whatever people can tell you. So ideally, as a beginner, right, I think you need to have two broad strategies in terms of finances. And that is the first one is you need a strategy to make money, cash inflow. The second problem you need to solve is a strategy to grow your money. So these are two broad strategies, right, which you need to have in your life, right? So a lot of people start out with the first one, which is how you need a strategy to earn money, right? And I think that if you are able to list out your talents, right, I think you need to really like sit down and write down what do you think you're good at, what do you like, and as what Ryan has mentioned in our previous podcast, ikigai, right? The concept of ikigai, right? Then if you can find something which you're good at, people will pay for and the world needs, right? Then I think you have found a perfect place, right, where you can thrive. Because I think it's very difficult if you are in a area, right, where you don't like, then you cannot make money, then basically you're like lost, right? And because of that, right, then that affects the other areas in your life, right? So from my experience talking to many people, usually, right, happiness is a function of many, many things that goes right in your life. And one of them is to make sure that you are at a place, right, where it allows you to grow your natural abilities very fast. That's why I always say, like, usually my advice to most people who are like fresh grads, right, I always tell them, end of the day, maybe the first job you do, the second job you do, maybe it's not something which, earns you a lot of money, right? Not really something you like. But that's okay. Because you in unlike school, right, you're allowed to make mistakes. You're allowed to experience working life. But I think after a certain X amount of time, right, you need to have courage to basically believe in yourself, right? To know that you can do more than what your boss tells you. And don't let your value be dictated by what the company says or the boss says about you. You need to be the driver of your own life. I think that's what I'm saying. So, like gathering confidence, all this is not something which I think comes overnight. It's a never-ending process of a lot of self-introspection. All right. And I will say that what has helped for some of my clients, including the high-functioning ones, right? Especially if you're very like super busy, like working like like literally like 80-hour work weeks. I ain't got no time to introspect. One of the ways I can suggest, right, is that you might want to outsource that introspection to a therapist. Because therapists, right, their job is to make sure, right, they help you basically they help you open up your mind and help you introspect, ask the right questions in your benefit. And that's one of the most recent realizations that my friend actually told me. Right, she says that high functioning people should invest in therapists, and I completely agree because I think end of the day, right, when you're a very busy individual and you don't have time to do it yourself, then it does make sense for you to outsource that to someone else who can do it better for you. And actually, like the difference between a person who is like doing very well versus a person who is like slightly above average. In my opinion, it has nothing to do with in terms of it has really nothing to do with intelligence, I feel. Because but after a certain amount of IQ, right, a lot of this IQ is diminishing return. Like once you have like IQ of 120, right, actually anything above that, right, you become a disabled person because you think too much already and you're too smart, right? You become a intelligent idiot, right? So my perspective is like know when to stop that, and start focusing on the doing. Because I think end of the day, right, results don't come just by thinking. You need to combine thinking with action, then you'll get the result, right? So I think what will help is that, if you have the money, therapy is a very good option. Okay, if you want to do it yourself, then I think at least 1 week, 1 day a week, right? You need to set aside time for yourself and pay yourself in terms of time and sit down and then consolidate your thoughts. Because that's what I do, right? Every single week, there's a 1 day where I really sit down and think. Then every single year, there's like 1 week I take a break from the year, right? And then I really sit down and plan what I want for the next year and 5-10 years and to see and to self-check reality, whether I'm in the right direction.
Yeah, I think we've covered this quite extensively in our careers episode, which is episode 5. You can go check that out. But coming back here to the question, right? I think relying on one source of income is not particularly a bad thing, nor is it like a good thing. It's just whether you have one or two sources of income. And I guess the real question you need to ask yourself is whether you want additional cash flow or do you want to grow your wealth in the long term, because there's many ways to actually increase your cash flow. Dividend stocks is one thing, rental income is also one thing, starting a side hustle is also another choice which could help you to grow your cash flow, so you'll be like in a more comfortable position monthly or like weekly. But if let's say you're aiming to grow your wealth in the long term, again, it's a time frame thing that you have to set for yourself. Whether it's like a long term thing or a short term thing, you need to understand the trade you're going into. If particularly like us, you go into the growth stocks, you would have to be prepared to hold and even experience losses in the first few years, and then only after a few years maybe you will see that exponential growth. So in short, I feel it's kind of like you need to ask yourself and be honest on what you want, but relying on one source of income is not particularly a bad thing, because you can always raise your income through job hopping or asking for a raise.
Okay, I think we can go to the next question, and that is passport and citizenship, diversifying with passports. I like this question because there's something which is a bit unorthodox, right? And apart from diversifying in terms of like, I think your money and in terms of like your wealth, in terms of your time, right? I think this is something which I think not many people actually think about in terms of like passport, citizenship, and your location, right? So I think I had this idea about diversifying in terms of like places that I want to be in the world. I think about 5 or 8 years ago, right? But unfortunately, I couldn't do it back then because I just think that the world just wasn't ready for the work from home model, right? So when COVID hit, right, it pretty much was a proof of work or what I've already been thinking about for the last like 8 years. And that is the way that I was envision a world, right, is that people can work wherever they want in from a laptop in the next 10 to 15 years. And I've spoken in depth about this, right, in the last podcast called Abundance, right? And I think once people have a taste, right, of what it is like to work from home anywhere in the world, right, this is something where companies who actually strive to provide this type of culture will start to outperform companies who wants the employees to come back to work physically. Unless the business is like Tesla, where you have no choice but to make physical goods happen, right? But I think ultimately, right, I think a lot of businesses, right, they just underestimate how much more productivity workers actually do by working from home. I think this is something which is understated because when during the COVID lockdown, right, where a lot of people actually work from home, what I realized, right, is that actually a lot of people, right, put in a lot more effort and hours into their work compared to if they went to the office. Because if you exit your office, you don't need to work. But the moment you work from home, right, pretty much the business has 24/7 access to you. And during COVID, I can tell you a lot of my friends and my clients, right, they were working from home and they can work as late as 1 a.m., 2 a.m. in the morning to get shit done. So yeah, so I think like it is going to be very apparent, right, in my opinion, that assuming we're going towards this model, right, that basically in order for people to best effectively work from home, I think in the next like 5 to 10 years, right, that inevitably the question about diversifying with passport, citizenship, permanent residency, and visa will come into play. Because the reality of this, right, is that in places like I've mentioned, in places like ASEAN, right, countries are already issuing brand new visas for digital nomads to work in that country, right, for 1 year and renewable years, right? And it is already happening. So, why would you want to, let's say, consider diversifying with a passport, assuming that your country allows you to do it? For Singaporeans, we are not allowed to. Singaporeans, we are only allowed to have one passport, right? But if you live in a country where they allow you to have more than one passport, that is something which you might want to consider, because I think that people always ask me what is the biggest cost in terms of like what's the biggest cost in a person's life, right? In my opinion, the biggest cost in a person's life has nothing to do with the spouse they choose, has nothing to do with the investment they choose. To me, the biggest cost in your life is your government, because your government is the one that sets the rules about how you actually will earn your money, how you will save your money, how you will allocate your money, and how your currency will perform, correct? So in terms of this, right, that's why I do feel like this is a particular sector which I foresee in the next 5 to 10 years, there will be businesses, right, worth billions of dollars to actually solve this issue of passport and citizenship and visas. Because I already see this happening in Southeast Asia. In Southeast Asia, there are businesses, right, that actually basically all they do is basically help foreigners, right, get their visas done. And it is something which is, I think, very profitable in terms of that scale, because I can see multiple of them happening around ASEAN. So if you ask me, right, I think this is one very big opportunity that will probably come at higher speed, at higher returns in the next 5 years. And I don't think it's going to stop, because once people realize they can work from home, right, anywhere, there will be many, many young people at the ages of 20 and 30, right, who will not want to stay in their home country. They wouldn't want to. Why would they? Because, like, assuming, let's say, if I'm in a country, right, let's say I'm in my early 20s, and the country is an aging population. Why would I want to stay in an aging population? I wouldn't want to, because like a young person in Japan, right, today, if they stay in that particular country, right, I would say that they might consider going abroad, right, and do better. Because from my experience looking at digital nomads, especially in around ASEAN, right, what I realize is that digital nomads are a lot more dynamic in terms of personality. They are a lot more open in terms of their thinking. And honestly, a lot of them do better than compared to if they stay in their own home country. And this is a fact. It's a very consistent trend that I see. Digital nomads around ASEAN, they're doing a lot better than if they actually stay in their own home countries. Healthcare is better, rental prices are better, and it's more competitive.
This is basically geographical arbitrage, where you earn a salary with a underlying currency which is stronger, and you go spend it in a country where the currency is actually weaker. So everything will be cheaper by multipliers.
I mean, put it this way, the days, right, where you have to wait until the age of 60 for you to stretch your dollar in a foreign country, that day is over already. If people are doing that during their retirement, I can bet you, right, that in the next 5 to 10 years, people in their 20s are going to go abroad and basically figure out a way to stay abroad, right, for long term. Because this is already happening. I'm already seeing it happening. So in terms of diversifying, right, basically what this will bring in terms of value, right, to people around the world is that people who have global skills, people who can speak very good fluent English, people who can speak Mandarin, these type of languages, and you have skills, right, to offer to first world countries, All right, you can be earning 30% less, but that is still a multiplier effect compared to if you stay in your own home country. All right, and that is going to basically like even out the playing field in terms of talent, because effectively what you are going to realize is that a lot of businesses, right, that actually set up to hire local talent in Malaysia and Singapore. The businesses itself are actually arbitraging in terms of like the income. They are, because like a developer in Singapore, you're earning like 6,000 Sing dollars a month. If you're super good, maybe 8,000. But the developer, right, the price of that in US, right, they're paying at least like 120K, excluding bonus, overtime, and benefits in US. So actually, in terms of arbitrage, the Singaporean local talent, even though if the talent is like similar, right, you're still getting a 30% haircut, right? In Malaysia, it's even worse. In Malaysia, your ringgit is against you, right? Then they basically squeeze you. So honestly, you ask me to diversify, right? Actually, it makes more sense if you know you have world-class talent, right? That you try your best to get out of that business who has monopoly over you, right? Into a first, to basically you cut out the middleman, right? Fuck the middleman who set up the business here and basically just go straight to a supplier, which is the employer. Yeah, so like in terms of this is what I'm saying lah. So you ask me like diversifying with passports, right? I don't think passport is the right way. I think passport only gives you the gateway, but I think the right mentality is diversifying with basically visas and geographical arbitrage.
Here's how I see it. Basically, geographical arbitrage. The real alpha here is that when you earn money in a stronger currency and spend it in a country where the currency is weaker and also the living cost is maybe also cheaper, then you can save and invest the remainder. So at least that's how I see it. But anyways, I guess we've reached the end of our episode today. So before we sign off, Aaron, do you have any last words you want to share with the audience?
I think I enjoyed this particular episode a lot. So apologies for my vocal cord destruction voice today because I'm recovering from a very bad cough. But I hope that I was at least most I would say like at least 80% of what I say is comprehensible.
Yeah, thank you so much for powering through this 3 hours.
I don't know, but it's quite. But I'm glad I'm still able to do this. So I think I should be back in tip-top condition in our next episode. How about you, Ryan?
Yeah, I think we've covered pretty extensively on diversification today. Hopefully, this podcast can be the end of all debates whether diversification is actually a great tool or not. Personally, I still believe that concentration is the greatest tool or greatest alpha that any retail investor has to actually outperform the market. But again, like we discussed, concentration can be detrimental. So you have to be honest and put aside your pride, face the facts for what it is. And invest safe, friends. So we're both on Instagram. If you like to follow us, my Instagram handle is called Food and Stonks. And Aaron's is Aaron's Goes Global. Thank you for tuning in, and we'll see you in the next episode.